Welcome back to the European Market Open. A minute to go until the start of cash equities trading. I'm Anna Edwards, live in London with Tom Mackenzie.
And here are your top stories. The chip crunch bites Apple. The tech giant is likely to slash its iPhone production target on the processor shortage. Shares fall on the Bloomberg scoop. The Fed's Raphael Bostic calls transitory a, quote, dirty word as the inflation surge lasts longer than policymakers expect. We get US CPI today. And LVMH sales beat expectations, but growth slows at the world's biggest luxury company.
So we're heading into another trading day with fairly flat expectations from futures markets then, Tom. The big picture, the big macro story, of course, will be inflation numbers out of the United States a little bit later on. Here in Europe, we've had a bit of corporate earnings just to get ourselves started. We've got bank earnings coming from the United States later on today. So you really think we're going to be starting to look in earnest at the earnings picture from here, aren't we? But for the moment, as we wait for the inflation narrative to get its latest input, what do we see on these European equity markets?
So the FTSE 100 is opening down 0.1%. We had the GDP numbers, of course, you were discussing with Mark earlier in the hour. 0.4% month on month for the month of August. The estimates were for 0.5%. Nonetheless, of course, growth continues to expand here in the UK, though there are question marks as to whether it starts to slow, what it means, of course, for the BOE as markets price in a rate hike towards the end of this year. Currently down now 0.4% for the FTSE 100. Over in Spain, you're seeing losses in similar territory as well, down 30 points. The CAC is lower by 0.1%. The question marks around inflation, of course, US CPI, as Anna was saying, out later today. Will that start to change the narrative? Will you hear more Fed officials like Bostic start to question the transitory nature or not of inflation? Let's switch it on and have a look at the sectors to see how things are shaping up just in the first few seconds of trade. The energy sector is currently down 0.2%. Similar territory for utilities as well, down 0.2%. You're not seeing a lot of movement in energy prices today. Oil remains for both WTI and Brent just above $80 a barrel. There's been a little bit of softness in the last few hours. Banks currently trading lower by close to 0.2%. We do have bank earnings, of course, later, which will kick off the earnings season. That, of course, along with supply chains, inflation, are some of the key factors investors are eyeing. Technology currently down 0.3%. That is the shape of play just a minute and a half into the trading session here in Europe. Anna.
Okay, so European equity markets then opening just on the back foot a little this morning as we wait for that inflation number. Stagflation is the hot topic on investors' minds, with one of the causes being the persistent shortages crimping supply chains. US banking chiefs weighed in on this at the Institute of International Finance.
Do I see persistence in inflation? Yes. I believe it's more than transitory related to supply chain issues and commodity prices.
Hopefully it will straighten out over the next 6 months. History would show it should. If the supply chain holds people back from certain goods, they find other places to spend it.
People are very, very confident that, they are transitory, that they will be solved. And whether it's 3 months, 6 months, 9 months, I don't know. I don't think it'll be longer than that. So, I am confident that we will get past this.
Joining us now, James Athey, Aberdeen Standard Investments Investment Director. James, really nice to speak to you. So give us your sense then of where the US inflation story peaks, where or when. Which do you think you've got a better handle on? What are we able to say with any certainty about the inflation story in the US at this point?
Nothing, Anna. Is that the right answer?
I knew you might say that.
I've long been of the opinion that inflation is not a concept that we understand well at all. I don't think any of the macro theories are robust. I do believe that there's an interplay between macro and micro, and that makes it very difficult to understand and very difficult to model. And what we've experienced in recent months, what we're experiencing at the moment, is a combination of these gigantic forces colliding in a way which raises the difficulty of making those forecasts, more than a few days, weeks or months hence. Very difficult indeed. So I don't know. To me, the weather debate, I think, sometimes implicitly goes awry is people thinking about levels and not thinking about changes. Inflation is a rate of change, obviously. We see percentage changes being reported as the rate of inflation. There is a difference between saying that prices will not return to their prior level and saying that inflation will continue. And I think where we see these supply chain issues, it's not sufficient for supply chain issues not to be resolved to get an ongoing inflationary pressure. They would have to continue getting worse, to continue driving prices to increase rather than prices just remaining elevated at a rather high and let's say unnatural level. So broadly speaking, when it comes to transitory, I need to at least see past the first year-over-year comparison so that we can get through all the base effects. I need to believe that things are getting worse in terms of disruption to global supply chains, and I need to believe that wages will be able to at least keep up with those headline price pressures. And so far, I don't see evidence that we're going to tick all of those boxes. Therefore, I think it's an inflation shock. That's the term I used at the back end of last year to describe what I was expecting. I think it's a shock. I just think it is going to be bigger and more persistent than we maybe expected at the back end of last year.
It's a shock, more persistent than we expected last year. That seems to align with what we're hearing then from the Fed boss over in Atlanta, Raphael Bostic. Take a listen to what he had to say on this.
It is becoming increasingly clear that the feature of this episode that has animated price pressures, mainly the intense and widespread supply chain disruptions, will not be brief. Data from multiple sources point to these lasting longer than most initially thought. And by this definition, then, the forces are not transitory.
So that was Bostic's view. We also heard from the Vice Chair of the Fed, Richard Clarida, saying that the conditions essentially have been met for the taper in November. So we look past the taper. Can we start now to price in an earlier rate hike cycle from the Fed? Is that what investors should be looking at?
Essentially, yes, I think that's what investors are looking at. The Fed narrative has evolved in quite a steady, consistent and reasonable fashion, but it's most certainly evolved towards the views of the more hawkish members of the committee. I continue to think that that's likely to be the case because the problem the Fed has, the problem that any of us have, is that there is a sort of path dependency, if you like, and they need to be able to sort of buy themselves the option of hiking sooner within the framework that they've created, which is that they've made it very clear that rate hikes will not happen until they've finished with the balance sheet unwind. That's not been the case, for example, at the Bank of England. And so they do have a bit more flexibility and optionality. The Fed doesn't. So it's sort of forced itself to get on with taper more quickly so that if it needs to get ahead of, I think, rising inflation expectations mainly, that's the big concern for the Fed, is that inflation expectations become anchored at a higher rate of inflation because of just the magnitude of price rises we're seeing at the moment. And in that respect, it's somewhat irrelevant if in a year's time we see inflation rate normalizing back towards 2%, if people have already affected and adjusted their behavior in the interim, that can override any of the other macro considerations because it then becomes a psychological phenomenon. So the Fed needs to buy itself the option to go sooner if needed. And I think it's right that the market is bringing forward the earliest rate hike.
Okay, but then, James, so do you adjust your portfolios around higher inflation from here, or do you, or not? Because I think from your notes, you're short US and UK inflation. So tell us the trades around this.
Yeah, and it is obviously very difficult because inflation in and of itself has an impact on markets, but obviously inflation then leading to central bank actions has an effect as well, and possibly those effects are not the same. So what the market was assuming earlier in the year, certainly in the first quarter, was we're going to get a load of inflation, but the Fed's not going to react at all. We've got steeper curves, we've got a weaker dollar. I think the Fed has shown that it's absolutely not willing or indeed able, given its mandate, to completely ignore these price pressures in the way that the market was assuming. That unpins the front end. To me, that's a different environment. That's nowhere near as happy an environment for equities, especially when you consider that this is all coming in a growth slowdown period. So I'm a little less concerned from a portfolio perspective about the near-term sort of inflation shocks and surprises. The way I see it is that the more upside inflation prints we get in the near term, the greater the probability that the Fed needs to be increasingly hawkish at a more rapid rate. And so flatter yield curves, stronger US dollar, certainly I think will benefit in that environment.
Okay, flatter yield curves, stronger US dollar. James Athey from Aberdeen Standard Investments stays with us. And coming up, the Bank of England seems on course to hike rates before the Fed. We'll talk about the outlook for monetary policy when it comes to the UK central bank. This is Bloomberg.
Of the Greek economic debacle. What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the European market open. 11 minutes into a trading session that shows some modest weakness as we wait for inflation data from the United States later on today. Let's have a look at some of the stocks on the move, though, because we're just dipping our toes tentatively into earnings season and getting a few trading updates as well from some European corporates. SAP up by 2.7%. So the stock doing pretty well after they boosted guidance. They raised their full year 2021 outlook. It seems that the cloud side of the business is behind this. Bloomberg Intelligence saying the results signal higher cloud spending, and to some extent this is having an impact on other software companies as well. We're seeing some of those move to the upside, the likes of Dassault Systèmes, Micro Focus, and some other names also moving a little bit higher this morning. So watch European tech on that one. Another tech theme, though, doing the rounds, Tom. Yeah, from software to hardware, then ST Micro is lower this morning. The French-listed chip and supplier company, of course, a major supplier to Apple. This is on the back of the Bloomberg scoop that Apple is looking to cut production by about 10 million units for its iPhone 13
13 because of supply chain constraints. ST Micro, as you can see, lower by over 2% so far in the session.
And thinking about the pandemic and the food delivery industry, which of course benefited so much during that, Just Eat Takeaway, the company coming through with new orders numbers for the third quarter, they maintained their 2021 guidance and in fact topped estimates with 25% order jump before their investor day. But it does seem as if some analysts have taken a gloomier view. Jeffrey's saying that Just Eat growth slowdown is larger than expected, and you can see the market responding negatively with a drop of 4.6% for that particular share price. Now, the UK Treasury and the Bank of England are working to start reducing the supply of stimulus long before the fallout from the coronavirus crisis comes to a full end. The speed of the reversal could risk complicating what's likely to be a difficult winter for Britain. The country is facing up to slower growth, widespread labour shortages and a cost of living crunch for some of its poorer citizens. James Athey from Aberdeen Standard Investments is still with us. James, what are you expecting that the Bank of England will really do here? We've heard a lot of commentary coming through. I know you've referenced Maradona in some of your thoughts on this, though, in the context that perhaps people don't always do what you think they're going to. So do you think the Bank of England is going to follow through on this hawkish commentary?
Yeah, the references to Maradona were most certainly in the context of Mervyn King's speech from a few years ago, not Maradona's social habits, let's say. Yeah, I don't think that necessarily means the bank is not going to hike. I do think the Maradona consideration is coming into it, the idea that you sort of talk hawkishly so that the market does the work for you, so that actually when you get more information further down the line, you're actually not compelled to hike because to some degree you sort of run ahead of that and conditions have shifted in the interim. That's quite a good way, certainly, of dealing with this idea of a transitory inflation shock. I don't think that necessarily means the bank is not going to do anything. However, I do think they, again, are shifting towards the hawkish end of the spectrum. And, certainly the data that's coming in is suggestive of broad enough price pressures and some wage pressures that the bank maybe thinks that, just getting away a little of the emergency stimulus is a good idea. And this is, I read the story that I think you guys are referencing that was co-written by Lizzie, and thinking about the stance of monetary policy rather than changes, I think, is sometimes instructive. Yes, of course, growth is slowing at the moment, and we still think that inflation is transitory, but ultimately the stance of monetary policy is as extreme as it was at the absolute height of the coronavirus pandemic, when economies were shut and GDP was falling by tens of % on an annual basis. So taking away some of that emergency stimulus, even in a slightly slowing growth environment where inflation is believed to be transitory, I can't see how that is particularly egregious.
Okay, it's interesting because some have come onto this show and discussed the possibility of a BOE policy mistake by raising rates too quickly, but it seems like you're suggesting the BOE could be behind the curve at this point.
Yeah, well, yes, I think they all are, to the extent that the rapid recovery that we've seen is now slowing, and they didn't use any of that rapid recovery to sort of chip away at the amount of stimulus in the system. And when both fiscal and monetary arms have got guns a-blazing at the same time, that's a heck of a lot of stimulus for the economy to deal with. And obviously what we're seeing is that demand has recovered faster than supply, and you're getting inflationary pressures, right? That's an open and shut case in these central banks' ideological or intellectual framework. That's an open and shut case. For the need to take away some of that artificial stimulus. So to some degree, yes, I do think they are behind the curve. Again, the fact that next year is going to be headwinds from both fiscal and monetary authorities shouldn't really be news. That's essentially been in our forecast since the back end of last year.
And where do you think the currency trades through all of this then, James? Because interest rate markets maybe have got used to the idea of the hawkishness and moved to price some of that in. The pound hasn't necessarily followed suit, and I've read stories about short positioning around the pound on expectations that something knocks the strong growth recovery off course. What do you make of the recent movement in sterling?
I've been a pound bull. We actually took our sterling long off just in the last few days, essentially because we had been concerned that the market was, viewing things through this lens. Lots of references to sterling as an EM currency because we've seen rates selling off and the currency weakening in various sessions recently. I looked at the Kiwi dollar, and to me, that was maybe an example of how the market's viewing this. First and foremost, there are a lot of other dynamics which are dominant. The macro dynamics dominate, so what the dollar is doing is hugely important. And to some degree, that can offset most of the idiosyncrasies. But you look at the New Zealand dollar, we've got an incredibly hawkish central bank that's already hiked now and is telling you they're going to do plenty more. And yet the Kiwi dollar has been weakening throughout that period. Why? Well, possibly because it's similar reasons to sterling, whereby it's a small open economy that is going it alone on a very hawkish path, and that hasn't tended to end well. So maybe the market looks through the additional carry and says this is a negative for the growth environment for a risky cyclical currency, and sterling certainly fits that bill. So we were sterling bulls. I still think ultimately it's cheap long term. We're concerned that Brexit considerations and the market believing the BOE may be back to committee policy error will weigh on sterling from here.
Okay, so maybe short-term pressure on sterling. We do, of course, have those political pressures around Northern Ireland as well back in focus this week, but longer-term bullish still on sterling. James Athey, Aberdeen Standard Investments Investment Director. Always a pleasure. Thank you very much indeed. Let's get the Bloomberg Flash now with Laura Wright. Laura.
Thanks, Tom. SAP has raised its full-year revenue forecast on accelerating cloud sales in a promising sign for turnaround plans at Europe's biggest software company. SAP says 2021's cloud revenue will grow 16% to 19% in constant currency from a year earlier. LVMH beat estimates in the third quarter, but growth slowed from the previous period when purchases of Louis Vuitton bags and other luxury items surged after stores reopened from lockdowns. Organic revenue at the fashion and leather goods unit rose 24% in the period from a year earlier. Tesla's China-made cars notched up another rise in domestic shipments to more than 52,000 units for September, even as general auto sales declined. Total China shipments for the month were up 27%. Once exports are included, that follows a near 50% jump in August. At last week's annual shareholder meeting, CEO Elon Musk said Tesla's Shanghai factory is now outproducing the Fremont, California plant. That's the Bloomberg Business Flash. Tom, Anna.
Thanks very much, Laura. Laura Wright here in London with your Business Flash. Coming up on the programme, Apple is the latest casualty in the global chip crunch as it's poised to slash iPhone production. We'll get the latest with Debbie Wu, who broke that scoop. That conversation next. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
Financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Saying it has accelerated innovation in the country and it's planning to appeal the FTC's decision. What's your take on this and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
Welcome back to the European Market Open. 22 minutes into a trading day that is fairly negative, actually. The CAC 40 and the FTSE 100 in particular under pressure. The DAX a little more resilient. Now, Apple is the latest victim of the global chip shortage. It's expecting to slash this year's production targets for its latest iPhone model by up to 10 million units. But the major chip makers warning that demand will continue to outpace supply throughout next year. There is no quick fix in sight. Let's get the details then with Debbie Wu in Taipei, who broke this story. Debbie, good morning from London. So what is leading Apple then to face a chip shortage situation at this point?
So the projected chip shortage situation is finally hitting Apple to a notable degree. And what is happening now is two of its major American chip makers, chip suppliers, Texas Instruments and Broadcom, are struggling to deliver enough components for Apple's production of its latest flagship iPhone 13 range. And what we are expecting here is that consumers now will see a delay in the shipments of their handsets when they place orders with Apple. So now the average waiting time for consumers to get the new iPhone handset is about like a month. So if you place orders now, you probably get your iPhones in mid-November.
Debbie, great scoop. What are the longer-term implications for Apple then as a result of these shortages?
So right now we are seeing this is more a supply issue rather than a demand issue. So while Apple is likely to cut its iPhone production goal for this year, the demand is likely to get pushed out to next year. So maybe in the short term we see some minor financial impact, but in the long run the demand right now seems to remain solid for Apple's flagship products.
Okay, so that's the demand side. What does this mean for Apple's supply chain? I mean, what can they do about this, Debbie?
So like you said earlier, there's no quick fix because it does take a year or two before foundries, that is chip plants that makes chips for external customers, to expand their capacity at the noticeable level. So some of the major chip makers are saying that they would expand demand to continue to outpace supply until next year, and then the chip crunch could last into 2023. And Apple's main chip supplier, TSMC, will hold its earnings call tomorrow. So all eyes will be on TSMC management's comments on how long they think this chip crunch will last.
Okay, Bloomberg's Debbie Wu there joining us out of Taipei with that scoop on the planned production cut by about 10 million units from Apple. Because of these supply chain constraints, Anna, have you upgraded to the iPhone 13? Is that something you're looking for? The Christmas season is upon us.
I don't know. My focus is elsewhere, Tom. I just ordered a new sofa with all the supply chain constraints. Well, I wonder whether that will materialise before Christmas. That's on my list. I was just looking at a piece of research coming through this morning on the Bloomberg saying a likely cut in Apple's iPhone 13 production targets could hurt revenue, but analysts are mostly remaining bullish on the stock as demand remains robust. So I presume you've put in plenty of orders.
Yeah, we're doing that. We're doing our bit to support Apple. This is what Debbie was saying. Like, their demand is still incredibly strong in the Chinese market, in the US as well. People have cash to spread, and they need to get the product into people's pockets, and that, of course, is the challenge. Okay, coming up, green bond boom. We saw this yesterday with the EU drawing record demand for its debut sale of the securities. We're going to discuss that next, the longer-term implications of that issuance. This is Bloomberg.
say, again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
Built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
Through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their mission.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. 30 minutes into our European trading day for this Wednesday. Here are your top stories. The chip crunch bites Apple. The tech giant is likely to slash its iPhone production target on the processor shortage. Shares fall on that Bloomberg scoop. The Fed's Raphael Bostic calls transitory a dirty word as the inflation surge lasts longer than policymakers had expected. We get US CPI today. And LVMH sales beat expectations, but growth slows at the world's biggest luxury company. Tom, we've got a number of macro things to watch out for. Of course, the inflation data is the big one here, but we've got individual corporates reporting as well and having an impact on these markets. Some of the earnings stories really capturing the market's attention. And I guess we figure as we go into the next earnings season what they have to say on inflation, on margins, pricing power, supply chain disruption. All of that will be watched really carefully.
Absolutely. We had James Athey on from Aberdeen earlier. He was saying, at least in his notes, that this is going to be one of the most interesting earnings seasons. Other people, of course, echoing that precisely because we will get that gauge, Anna, on just the impact of supply chains. As we hear from Apple that they are cutting production, planning to at least for 10 million units because of the supply constraints, even as demand for their products remains very strong indeed. That is, of course, a key component of it. The Stocks Europe 600 now pairing some of the heavier losses that we saw at the start of trade. 30 minutes into the trading session here in Europe, down 50 points, down 0.1%. The DAX is performing slightly better as a result, partly because of the stronger picture from SAP, the software company, boosting the DAX to some extent, up 0.1%. In terms of the CAC 40, that is lower by 0.3%. LVMH and the slowing picture for growth and sales there, particularly amongst its jewelry and watches division. The FTSE 100 is down by 0.5%. We had the GDP print coming out for the month of August, month on month, 0.4%, just slightly below the forecast of 0.5% in terms of GDP growth. Let's switch it on, have a look at the sectors. It was real estate yesterday, it was top of the pile. Things have shaken up and changed around today. Technology now gaining, despite obviously the longer-term concerns about the discount value as a result of those yields edging higher stateside, and of course those calls from many investors that you want to be looking at things like the cyclicals, banks, for example, rather than technology. But today, technology is top of the list, gaining 1%. Bottom of the list is basic resources, down 0.9%. Oil currently still around that $80 barrel for WTI. Brent a little bit higher, but it's been a bit softer in the last few hours. Maybe that is a factor for the basic resources sector, currently down at 0.9%. That is the shape of play currently as we look ahead to the CPI data out of the US, but also out of China as well, Anna, on Thursday. PPI and CPI from the world's second largest economy. Anna.
Okay, so the inflation focus continues. As we work our way towards COP26, we continue to focus on climate as well. The European Union drew record demand for its its debut green bond in its biggest ever deal. Both the demand and size eclipsed the UK's debut last month. The deal is just the first in a €250 billion programme of green bond sales for coming years, though investors may have to wait until 2022 to get more. Let us talk about this and other developments in capital markets. Henrik Johnson joins us, co-head of capital markets at Deutsche Bank. Henrik, nice to see you once again on the programme. And let me start by asking you about this big EU green issuance that we saw in markets yesterday, and indeed the market from here. What do you expect? Do you expect to see more green debt sales from here? Is this what's the size and scope of that? And do you expect that the greenium, the pricing benefit attached to this kind of debt, to stay at these levels or to move from here? What's your expectation in this market?
It's a great question, and we've seen over 100% growth year over year in green bonds, and I think that's going to continue. Obviously, at some point, there won't be any non-green bonds if it continues to grow at this rate, and so I think we're going to reach some sort of equilibrium where regulation is going to start questioning exactly how much green there is, and basically enforce the compliance with various green metrics. So I think in the short term, continue to grow, but I think there's going to be regulation coming in that'll put a damper on the issuance at some point next year.
How closely are you watching just how much these bonds do align with those demands and those needs in the ESG space? To what extent they are following the letter of the law?
So it really depends on what kind of green bond. So sovereign bonds typically don't have a lot of different KPIs that have to be followed, because sovereigns have a lot of ability to create green and ESG projects. I think it's much more interesting on the corporate side, where I think investors are going to be scrutinizing exactly what's in the specific terms and conditions of the green bonds. And I think corporates are going to have to really deliver on the goals that they're stating in their prospectuses. And just to your question about the greenium, clearly that's been a really positive thing in green bonds, because previously we'd had to pay up actually to issue green bonds. Now investors are definitely issuers are definitely saving money by issuing green, which is one of the reasons why we've seen such huge growth.
Okay, so issuers like them, but you've suggested that regulation is coming, Henrik, and that's going to weigh on issuance a little bit. Where do you see that regulation coming from? Over what time frame? Obviously we're moving towards COP26, but do you have anything more specific?
I think it's going to be multifaceted, because investors are going to be scrutinized themselves in terms of their portfolio. What do they own that is actually green? And obviously there's different shades of green bonds. So I think starting with the EU taxonomy and other regulation around Europe, companies are going to have to be a bit more specific as to exactly what they're doing to fulfill their goals. And I think the EU is going to be, and Europe is going to be a leader in that kind of regulation, mainly to avoid greenwashing, which obviously is a very topical topic right now.
Henrik, how much concern is there amongst borrowers around what we're seeing when it comes to borrowers in the primary market, what we're seeing around supply chain constraints and, of course, the expectation of higher rates from some of these central banks? How is that playing into the primary market?
Well, I think we're going to, a bit like you were saying in the introduction, we're going to have probably the most interesting quarter for many quarters, the one we've just started, because a lot of the mega trends that were previously driving demand, so central bank support, sovereign issuance, a lot of those are reversing. And so while green bonds, I think, will continue to be a real bright spot in the market, I do think that, for the rest of the issuance, and that's across equity, high yield, or in fact investment grade, it's going to be a lot more difficult. I think there's been a real shift where investors have a lot more pricing power, and issuers are going to have to pay up a little bit in order to place debt. Given all the uncertainty out there, whether that's the new earnings season, supply chain issues, and obviously the withdrawal of central bank liquidity, which will continue to be a theme.
Henrik, can you tell us a bit about the deal pipeline? I don't know if that's being influenced by the changes you describe there, but we've seen quite a lot of private equity interest, of course, in doing lots of deals. Is that still there? Is that still showing up? A PE still showing up with ample dry powder to use? How's that impacting the deal pipeline?
So a real bright spot, I think, in the investment banking landscape is that M&A is going to continue to be very strong. And as you say, that's driven by increased confidence among corporates and also lots of dry powder that sponsors have. So, deals are getting larger, and that's going to continue. But I think the financing that underpins it is going to be a little bit harder given the volatility that we're expecting. So that puts a certain amount of limit on what can be done. But overall, M&A, I think, is going to keep growing as the world is adjusting to the post-COVID realities.
We're seeing, Henrik, a lot more competition, of course, in the debt capital markets. Is that positive longer term, that added competition for issuers and borrowers? How do you view that change?
Well, taking a step back, we've come from the best ever time to have issued debt, and that's a period that's lasted for really a year and a half. So I think when I'm talking about volatility and uncertainty, we have to bear in mind that's from an incredibly strong base. So I think this kind of correction is actually relatively healthy because it'll mean that there'll have to be a bit more discipline, and I think an increase in yields is not necessarily a bad thing for the economy. Clearly, we have to exit at some point the extreme stimulus that we've all operated under. So I think there's going to continue to be a strong pipeline. Investors have a little bit more power. But don't get me wrong. This is still a great time to be doing deals because, from a historical perspective, the rates available in the market and the sizes available are still fantastic.
Okay, Henrik Johnson, co-head of capital markets at Deutsche Bank. Thank you very much indeed for your insights on the capital markets, the changes that we're seeing here around issuance, and of course that demand for ESG and green bonds. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. The world is failing to invest enough to escape climate change and avoid sharp increases in fossil fuel prices. That's the warning from the International Energy Agency. The IEA says that investment in green energy like solar and wind is lagging what's needed to meet climate targets. At the same time, it says fossil fuel spending is also insufficient to meet the current growth in demand. China's exports surged to a new monthly record in September. Strong demand in advance of the holiday shopping season outweighed the effects of power shortages across the country. Exports grew 28% in dollar terms from a year earlier, beating economists' expectations for a 21% gain. The House has approved a short-term increase in the U.S. government's debt limit, sending the legislation to President Biden just days before the Treasury was set to run out of borrowing authority. The vote only delays another partisan confrontation on debt and spending in less than 2 months' time. The UK says the Northern Ireland Protocol is harming the region and has to change. Speaking in Lisbon, Brexit Minister David Frost called for the current agreement to be replaced. Frost did leave the room for compromise, saying the UK is prepared for a negotiation with the EU without triggering a larger trade war. The EU's chief Brexit negotiator will lay out a counter-proposal today. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Tom, Anna.
Laura, thank you very much indeed. Okay, coming up, Standard Chartered CEO Bill Winters talks about the need for more transparency in the carbon offset space as we look ahead to COP26 next month. More from our exclusive interview with him next. This is Bloomberg.
from New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Welcome back to the European Market Open, 8:45 here in London, so 45 minutes into our European equity trading session. And European equity markets fairly mixed, actually, flat overall. The DAX, a bit of a bright spot, lifted by some technology names there. The SAP numbers resonating through the tech sector, through the software sector at least. And the CAC 40 under pressure. Just Eat Takeaway also in the mix here for you, down by 4%. We had numbers out from them, and it seemed as if the numbers actually, in terms of orders, beat estimates, but some of the analysts taking a gloomier view. Jefferies saying that Just Eat growth, their slowdown is larger than expected, and that seems to be a view shared by some others. And we see that the stock is under pressure this morning then, Tom.
Okay, let's switch focus to one of our big interviews of the week. The chief executive of Standard Chartered says it is unreasonable to expect banks to stop financing the fossil fuel industry. In an exclusive interview, Bill Winters told us that it's in part because doing so would undermine transition efforts, particularly in the emerging markets. He spoke exclusively to Bloomberg's Francine Lacqua ahead of COP26.
One of the criteria for our core carbon principles is that we do no harm. So if you're doing harm to local communities, indigenous people, to biodiversity, it's not going to qualify as a contract under our core carbon principle. That's the sort of the defensive approach. The offensive approach is to say what we want to do is create a market, and we are doing that right now, which says, yeah, this is the carbon standard that we set. But there's also, you may have additional attributes that are valuable to you. So local employment, protection of water resources, not do no harm, but actually do some good. You may want to pay extra for that contract. So when we talk to the people who are really big in the climate investment game, many of them happen to be oil companies or other large airlines. I mean, they're very advanced in their thinking on this. They're investing directly in projects to protect rainforest, but almost always with a secondary objective as well. Promote local employment, to protect biodiversity, protect natural carbon sinks that also protect biodiversity. And they'll pay more for that because it's important to them in their business model. We want to make sure that we also capture that into the transparent market to help just get that virtuous circle where there's a sense that you're doing something good, but it's also by being transparent, you're getting the scale and the acceptability.
Okay.
That means we can do more.
Are we transparent enough?
Right now, no. Right now, the vast majority of what happens effectively in the climate offset space is over the counter and undisclosed. So we're trying to urge everybody to come forth, put the trades out onto a platform. So I think one of the things Standard Chartered has done is together with partners in Singapore, we've created something called Climate Impact X. And in fact, we've got our first auction of high integrity carbon projects that's coming out right now. 12 projects, all nature-based, for the most part in Southeast Asia, maybe all in Southeast Asia. And we wanted to create some noise around this and say, we want to be transparent. So it's an auction. We're going to publish the price. And hopefully that will bring more people into the market.
Bill, final question. When do you think will be the day where actually banks say, I am not financing fossil fuel anymore?
Well, it depends on what you mean by not financing fossil fuel. So I think the day that banks are completely disengaged from the fossil fuel industry will be the day that there's no more fossil fuels. But if you look at the International Energy Agency or Science-Based Target Initiative or people who have really studied this carefully, in 2050, we're still going to be producing oil and gas. Coal is more debatable, but we're definitely going to be producing oil and gas. But
no new wells. Nothing new.
Well, maybe new wells, but what we'll also have by then, and this is embedded in the science, is technology which is scalable and economic to take the carbon out of the environment, whether it's carbon capture or storage or development of green hydrogen technologies, things of that nature. But that's So out of the fossil fuel industry, I don't know. When can we stand up and say we are highly confident that we are on a science-based target to zero emissions consistent with the Paris Agreement, which should do our part to save the planet, like in the next couple of weeks?
Standard Chartered CEO Bill Winters speaking exclusively to Francine Lacroix, and another exclusive banking interview coming up later on today. We'll speak with Banco Santander's Anna Botín. That's tonight at 11 p.m. at UK time, 6 p.m. in New York. And we heard there, Tom, Bill Winters talking about climate and the way that banking rubs up against fossil fuel extraction, of course. And we're getting some really interesting lines coming out of Russia this morning.
Yeah, the Deputy Energy Minister in Russia saying that they essentially domestically now have enough gas. They're going to stop injecting additional gas into domestic storage on November the 1st. That is the line from the Deputy Energy Minister. Of course, the dependency of Europe on Russian gas has been central to what's happening in terms of these record prices we've seen in Europe, the UK as well. We know, of course, we're looking for that additional pipeline to come on, but how much LNG we're going to be getting, gas we're going to be getting from Russia has been central to this. The fact that they're now saying they're going to stop injecting domestically November the 1st seems pertinent.
Yes, and I think we're going to be hearing from President Putin himself a little bit later on, speaking at that Russia energy event taking place in Russia. So we'll certainly tune in for his words there. What does he have to say about sending further gas to Europe? That's been a theme recently. I was also taken by a red headline across the Bloomberg, sticking with the energy theme. Nyastar, this is a mining business, essentially, mines zinc and other metals, and process them as well. In response to the surge in energy prices, Nyastar will curtail production further at its 3 European smelters. It has operations in France, Belgium, the Netherlands, Norway, so it has significant operations in Europe. And this is due to significant increases in the cost of electricity in recent weeks. So we see the ongoing impact of the energy crisis here in Europe. Coming up on the programme then, European stocks erase early losses and now trade fairly flat. We'll get back to the market conversation. We're waiting for the inflation numbers later on today. We'll talk to our MLive team next. This is Bloomberg.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. 54 minutes into our trading day. European equity markets, as you see, fairly flat at the overall level. We've got Man Group in there for you, up by 6.5%. That on the back of net inflows in the third quarter, lifting assets to another record. Morgan Stanley saying these numbers are a clear beat. Let's take a look at some of the events we're watching out for then today. At 12 p.m. UK time, JP Morgan releases its third quarter earnings, then closely followed by US CPI. So we'll be straight into it with bank earnings and the inflation story. Later, Jeff Bezos's Blue Origin launches its New Shepard NS-18 into space with the Star Trek actor William Shatner on board, going very boldly to places that some few people have been before. And we'll have a G20 meeting taking place. That happens in Washington. And at 7 p.m., the latest FOMC minutes will be released. Tom.
Okay, joining us now is Noor Al-Ali, Bloomberg's MLive macro strategist, for a deep dive on these markets ahead of that CPI print. Noor, how are you thinking about the inflation input here within the market context with the central banks and these comments, seemingly fairly hawkish comments from the likes of Clarida and Bostic?
Yeah, I mean, Bostic is a known hawk, definitely, so I wouldn't expect anything different from him. The inflation print today is very important because it just cements our understanding of how the economy is doing right now as it ebbs and flows into that recovery mode that we've seen come back and stretch in globally, not just in the United States. And just a reminder, we're just that much closer to November, and that Fed tapering timeline is really becoming much closer. So this inflation print really will just cement those market beliefs that tapering is here, and now we're going to start talking about rates very soon.
Did you take much away from the UK data a little earlier? Something gave sterling a boost this morning, or is that just dollar weakness?
You know, it's definitely a dollar weakness move. I can see a dollar definitely dominating the British pound at least. But also in the UK, there are a lot of domestic issues here that are impacting there. But really, if we want to take a step back here, what's been happening in 2021 is a story of shortages globally, whether it's hitting the UK economy, and you see that in the August numbers definitely with their output decreasing. And also you've got Apple as well, and that story of chip shortage is really impacting their output there. So it's definitely a story of shortages that keeps coming and going as we toggle between the themes of this year between inflation and supply chain constraints.
Okay, Bloomberg's MLive's Noor Al-Ali with an insight there on the markets, of course, as we look ahead to the US CPI and how that informs the views, of course, on the Fed action. And she's saying taper essentially baked in. At least that's what investors think for November.
Right, and baked in. And we heard that same view from our colleague, from Gareth Whitcomb at JP Morgan, telling us in the first hour of the programme to look at the details in that inflation print. So we will do that later on. That is it for the European Market Open. Surveillance Early Edition is up next. Tom and I are off to radio. This is Bloomberg.
Dealing with that blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, But we have been robust in terms of meeting that to date.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop,
look
drop
great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
tie. Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
You clearly see the inflationary pressures. We've heard the narrative from pretty much any policymaker that you speak to that is transitory.
Data from multiple sources point to these lasting longer than most initially thought. And by this definition, then, the forces are not transitory.
My baseline case is not for stagflation over a medium run horizon.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Inflation risks in the frame. U.S. CPI is due today. The Atlanta Fed president, of course, brings out the swear jar and says transitory is a dirty word. Chip crunch bites Apple. The company is likely to slash its iPhone production target on the processor shortage. And Bill Winters exclusive, the Standard Chartered chief executive, does not pull any punches and tells us China is not dumb enough for Lehman moment. More on our conversation throughout this hour. Now, first thing is first, let's check in on the markets. A lot of the focus, of course, is on earnings. Yes, we're there. It's that time of year again. The focus is on earnings. We had LVMH giving an impetus for some of the industries, and you can see for the moment they're unchanged. So if we delve deeper, and this gives us a great indication actually of where we are on the FTSE, again, very commodity rich, so we look for margin pressures because of energy prices rising. The CAC 40 down some 0.2%. Again, it's very luxury rich, so LVMH yesterday giving an impetus that things are not too bad. Yes, growth is slowing, but actually they're still holding on to some of the growth overall, despite the concerns we have in China, and the DAX getting some 0.3%. Remember, today is also JP Morgan Day, so you can follow the live blog on Bloomberg. Now, Apple is the latest victim of the global chip shortage. It's expecting to slash this year's production targets for its latest iPhone model by up to 10 million units, with major chip makers warning that demand will continue to outpace supply throughout next year. There is no quick fix in sight. Well, last night, speakers at the Institute of International Finance weighed in on supply chain problems.
Do I see persistence in inflation? Yes. I believe it's more than transitory related to supply chain issues and commodity prices.
Hopefully it will straighten out over the next 6 months. History would show it should. If the supply chain holds people back from certain goods, they find other places to spend it.
People are very, very confident that, they are transitory, that they will be solved. And whether it's 3 months, 6 months, 9 months, I don't know. I don't think it'll be longer than that. So, I am confident that we will get past this.
Well, joining us now to talk more about supply chains is Elise Badois, Managing Director and Deputy Head of Research in EMEA at Citi. Elise, as always, thank you so much for coming on Bloomberg. We were hearing there from some of the chief executives talk about supply chains. And this, I know, is also what your research focuses on, is if you have, a lot of supply chains being disrupted, leading to inflation, what kind of earnings crop will we get?
So obviously, supply chain disruption is the highlight of this earnings season. We've had, in the first half, very high expectation in earnings, broadly met by the company, actually not always rewarded by the market, anticipating further supply chain issues and further inflation. I think the key at the moment is to look at the various sectors that we have and how the supply chain disruption differently impacts them, and I think we can go perhaps into that later on. But really the difference is we're going into Q3 and we're going to look for those signs, and investors are really positioning looking for that.
So how do you break down these industries? I know you can't talk specific stocks, but we had Apple, and that of course goes to, if you have deep pockets and you have a problem with your supply chain, then it could probably affect the tech sector as a whole, as opposed to luxury stocks that seem to be getting better. Like, how do you pick the industries you like?
So if you're really trying to look for the supply chain disruption and how it's impacting different industries, you have some industries that actually don't worry about it at all. Financials, for example. Obviously, financials at the moment, you've got dividends coming back. It's the best place to be if you're worried about supply chain. But leaving that aside for a moment, looking at, for example, the luxury space, obviously you have pricing power. Where inflation kicks in, where you have cost and disruption coming in, then really your pricing power does matter. Now, obviously, looming in the background is growth and China slowdown, and that's the issue that we face.
I mean, if you think inflation is coming and is rampant, and we'll talk a little bit about that more shortly, is it the right way to play it through financial? Is there actually another sector that could benefit from that?
Obviously, the obvious place, the well-known place, the classic place is energy, because energy will always, essentially follow inflation, and that's your best hedge traditionally. But I think as investors look forward, certainly what we advise, what our strategy would look at is also valuation. And obviously, with earnings momentum and dividend coming back, yields coming back, and a background where we are going to see rate hikes later in the year, certainly we forecast that. Citi expects 10-year Treasury yields to reach 2%. That's all going to favor financials. So, from our perspective, financials and energy would be two good places.
Do you actually, for example, break it down in U.S. industries compared to Europe, or because a lot of these companies are so global, it doesn't really make that much of a difference?
Yeah. So I think it's very important to look at when you think about inflation. Why do we have inflation? Why? Let's go back to that. We essentially you've got to answer a very strong demand. You had stimulus, which we expect to fade, obviously, and all of that has driven essentially very fast purchasing, etc., clogging the systems. Now, when we go back to the various industries and how they're impacted, initially we had strong support from demand, but as demand fades away, obviously we're going to have issue with margins. Margins tend to rise at the beginning of the cycle, and then they start to compress, and that's where we're going to see a bifurcation. So where in the past, for example, we might have recommended consumer discretionary as a great hedge, because actually part of consumer discretionary have very strong pricing power, and for example, consumer staples doesn't really have as much pricing power. Actually, at the moment, the issue we face is that earnings are going to decelerate, so the top line is going to decelerate as well, and that's an issue for more consumer type of sectors. Hence the recommendation to look more at, I guess, energy or financials.
Elise, thank you so much. Elise Bedouin, they're head of EMEA Equity Research at Citi, stays with us, and we'll talk more about also portfolio building, maybe the 60-40. We have a story on that's playing out very well on the Bloomberg terminal. Smart conversations continue right here on Bloomberg Surveillance Early Edition. Up next, we also hear from our interview with the Standard Chartered Chief Executive, Bill Winters. He talks about stagflation. We'll also get Elise Bedouin's thoughts on the subject. And then later on in the program, we speak to the former Unilever Chief Executive, Paul Polman, about his latest book on climate change and inequality. Now, if you have any questions for any of our guests, IB plus TV Go, or you can tweet me directly at Flacqua. This is Bloomberg.
China's growth because it is already slowing. Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, settled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
I think the biggest worry that we hear about is stagflation. So you clearly see the inflationary pressures. We've heard the narrative from pretty much any policymaker that you speak to that is transitory. And I think that the inflationary pressures are transitory. But I also see structural wage pressures that are building up on the back of a reasonably strong economy and other dislocations that will not be easily resolved. So I think the inflation trend is to say that it's purely transitory, I think would be a little bit dismissive. But unfortunately, economic growth, as we withdraw the stimulus plug, whether it's the early stages of pulling back from monetary stimulus and the inevitable contraction in terms of fiscal stimulus, both of which need to happen, we'll see the wind come out of the sail of the economy a bit. Thankfully, the momentum's quite good. In China, we're talking about growth dropping down to 5%, maybe a bit below for a while, but then coming back up. Okay, well, 5% is in the second biggest economy in the world is pretty good. The U.S., as we know, is tremendously resilient, and I think will also recover. So I'm not desperately concerned about the economy, but I think it's going to be a little bit harder.
And so that means, what, a correction for the markets?
Look,
or volatility?
Big question. I think the markets are extremely interest rate sensitive right now. So to the extent that the market really prices in short-term rates going up, I do think we'll have a correction at that point. But the underlying earnings still look okay. And even if we have global growth going a bit below potential, so down into the 3% sort of zone for a while, the underlying release of pressure that comes from the pandemic receding is pretty supportive for the global economy. So I'd say we feel okay about it.
Unless the energy prices put a lot of pressure on margins.
Well, energy prices are real, and this is sort of part of that this inflationary dislocation, which economists and others will debate at some length whether this is transitory or not. It feels a little bit stickier than complete dismissal. But yeah, for sure. I think if you got Brent into the well above 100 consistently, there would be an economic impact. But thankfully, the world is also becoming a little bit less dependent on fossil fuels, only a little bit less.
Well, that was Standard Chartered Chief Executive Bill Winters speaking about inflation. We'll speak to him a little bit later, or we'll show you actually when we spoke about climate change and also about fintech a little bit later in the program. We also have another exclusive banking interview coming up. We'll speak to Santander's Anna Boutin. That's a little bit later, 6 p.m. in New York, 11 p.m. UK time. Now let's get back to Elise Badois, Head of VMEA Equity Research at Citi. Elise, thank you so much, first of all, for sticking around. And we were just hearing from Bill Winters of Standard Chartered talking about stagflation, some of the dynamics that he sees in the markets. Are you expecting quite a lot of volatility as monetary policy and I guess central banks try to adjust to this new reality?
The key to watch is obviously this idea that I think he particularly highlighted the transitory nature of inflation. Everyone agrees on that. Essentially, if you break it down, my perspective is always bottom up as a head of equity research. If you break it down into wage inflation, perhaps commodity-induced inflation, input cost inflation, essentially the rhetoric has been that much of it is transitory. But actually, when we look at the data, so essentially we expect, for example, in the UK, inflation to peak at 4.8%. Now, obviously, when you look at it, it's supposed to accelerate on our economists, from 2.4% to 3.4% into 2022. Now, obviously, it's where we land in the end that matters. So actually, it might be transitory, but where does it land in, you know, what is the base level that we end up with? Because that is going to definitely impact the economy, the purchasing power, and the trend for the growth. So that is the key question with inflation. And I believe that, you know, we've just had UK numbers and they fell slightly, you know, they came slightly above, well, actually, you know, we just had some GDP numbers in the UK that were actually a bit below consensus. So we now find ourselves in a situation where we have inflation, but we don't really have the growth. And that gives a number of questions for next year in terms of how we're going to deal with interest rates.
Okay. We also had this crazy survey, and I say crazy because actually many different investors or traders have a different definition of stagflation. Where actually, you know, there's an economic definition, but what you think is a problem for central banks could be different from one trader to the next.
Right.
I mean, how much volatility does that mean for equities to come? How, you know, could we see like a schism as people interpret some of these numbers differently?
Yeah, I mean, let's take a step back and think about sentiment with equities. Obviously, the road is going to be bumpy from now on because earnings, you know, we expect EPS to go down from about 44%. You know, the earnings went up by 44% this year, EPS, and then they're going down to about 9% globally. The picture is sort of similar. Europe sits somewhere there, basically. It's quite acute for the UK. Earnings are going up 70% 2021 on our estimates. They're going to go down to about 2% next year because you've got a lot of you've got a mining component in the UK. You've got some really so actually as we go into Q3 and we're going to have news. We're going to have news about China slowdown, etc. That's going to, I think, even more than inflation. That's going to lead to a little bit of stress in the system. There's going to be that idiosyncratic news that makes the market worry. Why? Because also valuations are testing. And let's not kid ourselves. You know, essentially, you know, you've got testing valuation. Perhaps not in the UK, it's 12 times, but you've got the US on 21 times. And I worry that essentially we're going to have testing valuations, which lead to volatility on every bad news.
Elisa, what looks expensive right now? I mean, tech seems like the obvious way, but can you find value in certain parts of tech?
So in certain parts of tech, you probably can. I mean, you know, we've actually reined back tech to neutral, particularly because of the sensitivity to interest rates. But you will find in places some opportunities, particularly in Europe. But this is not big tech, big US tech. And on that, we're neutral and we're rated back to neutral. And that's really due to the interest rate sensitivity. I think, you know, when you want to look for value, obviously we do expect that value rotation to come. The UK is the best market for that, trading on 12 times, some good value plays there. And then, you know, other sectors that we would recommend, financial, healthcare, and industrials. Industrials still have some way to go.
What's your take on UK stocks at the moment? So given the multiples that you were saying, are you bullish that actually they
we're
look
very
attractive?
I mean, we expect some news on the UK. I think perhaps to give a little bit of a trick, in what we expect in terms of value realization sometimes comes in the form of M&A. So sometimes it's not all stocks all at the same time 2% a day. Sometimes it's going to be that sort of mid-cap M&A that we actually expect.
Elise, thank you so much for coming on today. Elise Badouader, head of EMEA Equity Research at Citi, joining us this morning. Now, coming up, Russia is seeing Europe's gas crisis as a golden opportunity. Will Putin push the EU to change rules on pricing and Nord Stream 2? We're live in Moscow next. This is Bloomberg.
every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Russia is seeing Europe's energy crisis as a golden opportunity. Now, fresh from his intervention into markets last week, Vladimir Putin now wants to press the EU to rewrite some of its rules around the gas market. Now, he may use a speech at the Russian Energy Week today to push the EU away from spot pricing towards long-term gas contracts, and even more importantly, a quick certification of Nord Stream 2. Well, joining us now to discuss all of this is our senior reporter for international affairs, joining us from Moscow, Henry Meyer. Henry, great to speak to you today. So there's a lot of things that Putin wants from the EU. Out of everything he wants, what will he get?
Well, I mean, certainly the top of the list of things that Russia is pushing for at the moment is to renegotiate the contracts for supply of gas to Europe. And in recent years, the European Union has insisted that a lot of these contracts shift to a price mechanism based on spot prices, whereas Russia prefers the previous system linked to oil prices, long-term contracts. So this is going to be one of the main demands that Russia makes. Senior Russian officials have been repeating this over the last few days, and they really do see this as an incredible opportunity that has arisen thanks to the crisis in Europe to press these demands.
So, Henry, will Nord Stream 2 actually become a bargaining chip in this ongoing crisis?
Nord Stream 2, yes. I mean, it's been such a problematic project that was held up for a long time by American sanctions. It is now finally constructed, but it's entering, a very complicated period now, regulatory approval in the EU. And again, Russia sees this as a fantastic time to push that through with the argument that if you don't allow us to use this pipeline to start pumping gas through it, we can't come to your rescue to help you, as you are asking right now.
Henry, thank you so much for the update. Of course, we'll have plenty more from Henry throughout the day. Henry Meyer there from our bureau chief in Moscow. Now, we'll have a lot going on, of course, when it looks at the markets and when we look at inflation expectations. This is a picture overall. Now, we look at exactly what we can hear from CPI later in the U.S., and then the focus, of course, will be on the banks with JP Morgan coming up shortly. Now, let's get straight, I think, to the Bloomberg First Word News. If she's here, she's Leanne Gerrans. Hi, Leanne.
Good morning, Francine, and sorry for being late. The world is failing to invest enough to escape climate change and avoid sharp increases in fossil fuel prices. That's a warning from the International Energy Agency. The IEA says that investment in green energy like solar and wind is lagging what's needed to meet climate targets. At the same time, it says fossil fuel spending is also insufficient to meet current growth in demand. Now, the House has approved a short-term increase in the U.S. government's debt limit, sending the legislation to President Biden just days before the Treasury was set to run out of borrowing authority. The vote only delays another partisan confrontation on debt and spending in less than 2 months' time. The UK says the Northern Ireland Protocol is harming the region and has to change. Speaking in Lisbon, Brexit Minister David Frost called for the current agreement to be replaced. Frost did leave room for compromise, saying the UK is prepared for a negotiation with the EU without triggering a larger trade war. The EU's chief Brexit negotiator will lay out a counter proposal today. US federal judges have upheld New York COVID vaccine requirements in 3 separate decisions as a contentious issue winds its way through the court system. The ruling rejected claims against mandatory jabs lodged on racial, medical and religious grounds. Meanwhile, Texas Governor Greg Abbott has outlawed vaccine mandates in the second largest U.S. state, setting the stage for a showdown with the federal government. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Apologies again, Francine.
Always, Leanne, we love you no matter when you arrive. Now, coming up, we speak to the former Unilever chief executive, Paul Polman, about a new book he's co-authored called Net Positive. It's all about climate change. It also tackles inequality and what we can do ahead of COP26. Later on in the program, we bring you more from our exclusive interview with Bill Winters. He also has a thing or two to say about fossil fuels and, of course, financing those. If you have any questions for any of our guests, just IB plus TV Go. This is Bloomberg.
Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Inflation risks in the frame. U.S. CPI is due today. Atlanta Fed president brings out swear jar and says transitory is a dirty word. Chip crunch bites Apple. The company is likely to slash its iPhone production target on the processor shortage. And Bill Winters exclusive, the Standard Chartered chief executive does not pull any punches and tells Bloomberg China is not dumb enough for a leading moment. More on our conversation throughout this hour. So good morning, everyone, and welcome to Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, first thing is first, we always check the markets to try and keep abreast of exactly what's going on. A lot of the focus, of course, is on earnings. We had LVMH giving a little bit of a lift to luxury stocks. Of course, a little bit, or growth slowed, but they're still growing quite significantly. And then the focus is on chip shortages because of that announcement from Apple. So the chief executive of Standard Chartered says it's unreasonable to expect banks to stop financing the fossil fuel industry. In an exclusive interview, Bill Winters told us that's in part because doing so would undermine transition efforts, particularly in the emerging markets. Well, I spoke to him exclusively ahead of COP26.
One of the criteria for our core carbon principles is that we do no harm. So if you're doing harm to local communities, indigenous people, to biodiversity, it's not going to qualify as a contract under our core carbon principle. That's the sort of the defensive approach. The offensive approach is to say what we want to do is create a market, and we are doing that right now, which says, yeah, this is the carbon standard that we've set. But there's also, you may have additional attributes that are valuable to you. So local employment, protection of water resources, not do no harm, but actually do some good. You may want to pay extra for that contract. So when we talk to the people who are really big in the climate investment game, many of them happen to be oil companies or other large airlines. I mean, they're very advanced in their thinking on this. They're investing directly in projects to protect rainforest, but almost always with a secondary objective as well: promote local employment, to protect biodiversity, protect natural carbon sinks that also protect biodiversity. And they'll pay more for that because it's important to them in their business model. We want to make sure that we also capture that into the transparent market to help just get that virtuous circle where there's a sense that you're doing something good, but it's also by being transparent, you're getting the scale and the acceptability. Okay. That means we can do more.
Are we transparent enough?
Right now, no. Right now, the vast majority of what happens in effectively the climate offset space is over the counter and undisclosed. So we're trying to urge everybody to come forth, put the trades out onto a platform. So I think one of the things Standard Chartered has done is together with partners in Singapore, we've created something called Climate Impact X. And in fact, we've got our first auction of high integrity carbon projects that's coming out right now. 12 projects, all nature-based, for the most part in Southeast Asia, maybe all in Southeast Asia. And we wanted to create some noise around this and say, we want to be transparent. So it's an auction. We're going to publish the price. And hopefully that will bring more people into the market.
Bill, final question. When do you think will be the day where actually banks say, I am not financing fossil fuel anymore?
Well, it depends on what you mean by not financing fossil fuel. So I think the day that banks are completely disengaged from the fossil fuel industry will be the day that there's no more fossil fuels. But if you look at the International Energy Agency or Science-Based Target Initiative or people who have really studied this carefully, in 2050, we're still going to be producing oil and gas. Coal is more debatable, but we're definitely going to be producing oil and gas. But
no new wells. Nothing new.
Well, maybe new wells, but what we'll also have by then, and this is embedded in the science, is technology which is scalable and economic to take the carbon out of the environment, whether it's carbon capture or storage or development of green hydrogen technologies, things of that nature. But that's so out of the fossil fuel industry. I don't know. When can we stand up and say we are highly confident that we are on a science-based target to zero emissions consistent with the Paris Agreement, which should do our part to save the planet, like in the next couple of weeks?
That was my exclusive interview with Standard Chartered Chief Executive Bill Winters. Now let's stay on the climate conversation. Former Unilever Chief Executive Paul Polman has co-authored a new book called Net Positive. It tackles climate change and inequality. Now he claims that to thrive, companies must become net positive, giving more to the world than they take. Well, Paul Polman, welcome to Bloomberg. A lot of the conversation, this is something that you've been spearheading or actually advocating for in the last decade at least. Are companies getting the message now, or do they just see the business opportunity?
Well, it's actually both. The business opportunities are enormous. We're discovering with COVID that we had to spend significantly more on treating the issue, which is a direct result of biodiversity destruction, climate change. The money we've spent, $16 trillion, $25 trillion lost in the global economy. I think many people have realized not only can you not have healthy people on an unhealthy planet, but the cost of our failings are enormous. So more and more businesses see this as an enormous opportunity. We now have 20% of the business community making commitments that are getting you to net zero by 2050, signing up to the science-based targets. And the movement that we have seen over the last 24 months has been enormous.
What does that mean, Paul, of what we can expect at COP26? A lot of investors, unfortunately, already think that we're not going to get enough agreements to make a real difference. We have, what, 2 weeks left until Glasgow starts happening. Is there anything that we can do in the meantime?
Yeah, well, partly it's management of expectation. If anybody expects the magic wand to come out at Glasgow and all of a sudden all of the line up to with real plans to decarbonize our global economy, it's not going to happen. So this will be a conference where we need to put the ambitions up, where we need to see significant progress and continue to work after that. The key thing is that we get more countries to commit to being net zero. We have moved up from about 40 countries a year ago to about 130 countries now to make that commitment. There are some countries trailing. More importantly, we want these countries to make commitments by 2030. Currently, our carbon emissions are projected to increase by 15% over this decade, whilst we need a 45% reduction. So that's by all means possible. And then we need to do some things because we're in this together. So we need to be sure that we have the 100 billion climate fund to help the emerging markets build adaptation and resilience. We have to be sure that we make some commitments to go out of coal, for example. We absolutely can't wait for that. And build this global trust, if you want to, that we're in this together.
Paul, I mean, we hear a lot about greenwashing, and we hear a lot about, credits that actually don't do much good because it's just disguising some of the bad things that are happening in terms of climate change. Like, what's the right approach? If you're a chief executive and you're committed but want to do more, what should you be looking at?
Well, what we talk about in our net positive, how courageous companies thrive by giving more than they take, is that first and foremost, the companies need to take ownerships of their total handprint in society. You need to, for example, when it comes to climate change, you need to take responsibility of your total value chain, not only scope 1 and 2, like most of them do, but the overall impact. If you're in the food business and deforestation or land degradation are part of the climate emitting things, you have to take responsibility and start to think net positive. Many companies are now making commitments, for example, to move to regenerative agriculture, capturing the carbon again in the soil versus degrading the soil, making commitments to not have deforestation in their value chains. This responsibility starts, and that is the most important thing. The second thing that companies can do is to join these coalitions to make these targets and these commitments public. And that hopefully gives the courage to many of the governments in this world to start to move faster. There's a clear gap right now at the governmental level between the say and the do that needs to be closed. And we certainly have that opportunity between now and Glasgow to give them a little bit more courage, may I say.
Paul, is there a danger that actually, finance that could be a force for good is a force for advancement, but also greenwashing? And what would be the one thing that you would tell asset managers and finance who want to do good right now?
Well, I think more and more people in the financial sector have caught on that that moving to more ESG or climate mitigation is the way to go. We now have over $90 trillion of money on the management making financial commitments for Glasgow under an initiative that Mike Carney is leading to decarbonize their portfolios and stay below the 1.5 degrees. We have the TCFD coming in. It was 100 companies. It's now 2,300 companies. We have more and more countries putting it in legislation. A year ago, it was 9. Now it's 45. So the financial market is moving. ESG investment is increasing. It's estimated to be about $50 trillion by 2025. So I would say you'd be stupid in the financial market if you don't want to be aggressively a part of that. Yet, we still see behavior that is not consistent, where there is short-term money to be made, still enormous lending by some of the biggest banks to coal, still financing transitions that move in the wrong direction. So we need to get this collectively up to the levels if we want to reach the ambitions. It's a bigger gap that we have to overcome than perhaps some people realize.
Paul, give me a sense of exactly some of the things that actually, you worry about. So this is definition, a common definition, this transition phase. If you look at the energy crisis, is it worrying that we've had to go back to, coal plants, for example, in China? And will that just give an excuse to governments to delay this transition?
The current crisis that you see on the energy market is a crisis partly driven by transition pains and partly driven by bad planning at the global level, with the global economies coming out shorter term out of this pandemic low base, and we weren't very well prepared for this. The China demand, obviously, the lack of reserves in Europe, but more importantly, the underinvestments in green energy. What the International Energy Agency and others point out, study after study, is that by all means we can get to the commitments that we've made of a 45% reduction in the next 10 years, provided we step up. We need to at least step up by a factor of 3 the money that we spent on green energy. And unfortunately, what we have seen a little bit with the government spending coming out of this terrible crisis is that it is easier to go short-term back to the old economy and keep some of these systems in place than moving to the new economy. So it takes a little bit of an act of faith, and with the politicians being under pressure and often focused on the next election cycle, we have to be sure that there is enough voices from civil society, from the NGO community, from the business community, that this is the moment to move forward. There is actually no alternative here.
Paul, thanks so much, as always, for your time. Paul Polman there, former Unilever chief executive and co-author of the new book, Net Positive. Now, fintech may be a game of life or death for big banking institutions. Up next, we'll speak more more of our exclusive conversation with the Standard Chartered chief executive, Bill Winters, and his take on innovation in the digital banking space. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, one day, there will be two kinds of banks, those that are still relevant and those that don't have a strong digital banking presence. That's according to the Standard Chartered chief executive, Bill Winters. Now, he says that his bank is doing a great job of innovating internally, but shareholders won't take into account the value of fintech within big institutions until it starts to show profit. Well, I caught up with Bill Winters yesterday.
I think what we're seeing right now is that the biggest fintechs are actually happening within banks. Now, they get lost in the context of the bigger bank, but when you look at the amount of deal activity or transaction activity that's going through some of the very high market value fintechs right now, it's actually quite small relative to the identically digitally driven volumes that are happening in banks. But because they're not very profitable, and we see that from the profitability of fintech, I mean, most of them aren't profitable at all. And certainly inside banks, they're no more profitable at this stage, maybe a little bit more profitable if we can get to some scale quickly. But they're not turning the dial in terms of your bottom line operating earnings, and therefore it's not finding its way into value. But the relevance to customers is very clear. And it starts with the things we all know about, which is small value payments. The fintech industry disrupted small value payments. Banks have quickly caught up, including cross-currency small value payments, so remittances and cross-border payments. And that's I think banks are delivering that quite well. The fintechs are super creative, and they're well-funded, extremely creative, and very fast. And don't have the legacy infrastructure that the banks have, and probably don't have quite the same regulatory oversight, although our regulators would never acknowledge that.
But is it, buy now, pay later?
I think as we moved from the liability side of the bank balance sheet, which is deposits and then payments and foreign exchange off the back of that, it's definitely moving now into credit. And it's interesting that some of the earliest fintechs were actually peer-to-peer lenders, right? And the peer-to-peer lenders had carved out what everyone thought was going to be a fundamentally different way of intermediating credit. They have a role to play, but it hasn't been a huge game changer in the world. But the fintech applications, I think, could be, mostly because of the access to data that the big technology companies have from the convenience platform. So if you look at the phenomenal success of Alibaba and Financial and Tencent, obviously that subsequently has incurred some regulatory problems, but their ability to understand their customer better and to make better credit decisions, I'll say for the benefit of us and others who then took those loans off their origination channel, it's very, very strong. We're doing the same thing with a project that we call Nexus in Indonesia, where we partnered with Bukalapak, biggest e-commerce platform in Indonesia, 100 million customers and growing super fast. And we were delivering a full range of banking products, including, as we rolled them out, buy now, pay later, and other credit products, credit cards, and then eventually wealth products and other things.
Well, that was our exclusive conversation with Standard Chartered Chief Executive Bill Winters. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sources tell us Apple is set to slash production of its iPhone 13 by 10 million units due to the chip supply crunch. We're told the company had expected to produce 90 million handsets in the last 3 months of the year, but component shortages from Broadcom and Texas Instruments have forced a cut. The average lead time for chips rose for a 9th straight month in September to more than 21 weeks. Now, China's exports surged to a new monthly record in September. Strong demand in advance of the holiday shopping season outweighed the effects of power shortages across the country. Exports grew 28.1% in dollar terms from a year earlier, beating economists' expectations for a 21.5% gain. SAP has raised its full-year revenue forecast on accelerating cloud sales in a promising sign for turnaround plans at Europe's biggest software company. SAP says 2021's cloud revenue will grow 16 to 19% in constant currency from a year earlier. Tesla's China-made cars notched up another rise in domestic shipments to more than 52,000 units for September, even as general auto sales declined. Total China shipments for the month were up 27% on exports are included. That follows a near 50% jump in August. At last week's annual shareholder meeting, CEO Elon Musk said Tesla's Shanghai factory is now outproducing the Fremont, California plant. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, coming up, the luxury boom continues as Beijing's crackdown on China's mega-rich fails to impact sales. We have more market reaction on LVMH's third-quarter sales boost. That's coming up next, and this is Bloomberg. inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's take a look at what we're watching out for today. At 12 p.m. UK time, JP Morgan releases its third quarter earnings. Then closely followed at 1:30 p.m. is US CPI. 1:30 p.m. Jeff Bezos's Blue Origin launches its New Shepard NS-18 into space. And then at 3 p.m. G20 finance ministers and central bank governors meet in Washington. 7 p.m. watch out for the latest FOMC minutes. They're released, and then later on, the IMF Managing Director Kristalina Georgieva speaks during the IMF and World Bank annual meetings. Now, on to some of the earnings that we had over the last 24 hours. LVMH growth slowed from the previous quarter when sales surged post-lockdown. Still, organic revenue at the fashion and leather goods unit rose 24% from a year earlier, beating analyst expectations. Now, LVMH says it's confident that the current growth will continue. Well, for more on all of this, we're joined by Bloomberg's Deirdre Hipwell. Deirdre, thank you so much for joining us. It's an exciting space, and I guess investors are a little bit or less worried than they were maybe 24 hours ago, because LVMH, the first to report a trading update, and, you know, in terms of trend, it's growing not as much as it used to, but it's still growing.
Absolutely. I think investors will be very reassured by these figures. Overall, the results were in line, and in fact, leather and fashion goods, which is the really key unit at LVMH, actually performed better than expected. And, you know, on a two-year basis, fashion and leather sales were up 38%, which is pretty extraordinary when you consider we've had a global pandemic in the midst of that. Yes, the growth has slowed from the second quarter, but in a way that's not surprising, because if you think about what was happening in the second quarter, we were all heading back to the shops after lockdown ended, so there was a real bounce back in spending. So I think overall, as you say, LVMH goes first, and I think investors will feel very reassured that it shows that there is still growth in the sector, maybe just not at the same pace as before.
So, Deirdre, investors worried about China ahead of these results. Did LVMH also reassure about China?
Well, yes, I think they did. Obviously, the push for common prosperity in China and the efforts to reduce the wealth gap had been weighing on luxury stocks, particularly in August. But on the call yesterday, LVMH's CFO said that they weren't particularly worried about it, and they didn't think it would have a major impact on the kind of core upper middle class customers that make up its client base. So I think investors will take a lot of heart from those comments.
So, Deirdre, are Chinese visitors actually returning to Europe?
Doesn't seem so at the moment. I think there has been some return, but LVMH was saying that they're not seeing the same trend in Chinese tourist sales in Europe yet. Partly this might still be to do with a lot of the travel restrictions that we're seeing. And obviously, luxury retailers will be hoping that returns, because that has often been a big driver of growth. But at the moment, they're not back at pre-pandemic levels.
Deirdre, thanks so much. Deirdre Hipwell there from Bloomberg. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons will be in New York. We look at full earnings. Of course, we have JP Morgan coming up, so we'll have a full roundup of the bank earnings. But in general, European stocks, U.S. equity futures also bouncing before inflation data out of the U.S. Again, if you look at some of the earnings report, a lot of the focus will be to try to figure out what these rising costs mean for corporate health. And then, of course, one of our main stories is Apple because of the chip shortage. This is Bloomberg.
Wrong with her eye. When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone, and I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City. We're here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
You clearly see the inflationary pressures. We've heard the narrative from pretty much any policymaker that you speak to that is transitory.
Data from multiple sources point to these lasting longer than most initially thought. And by this definition, then, the forces are not transitory.
My baseline case is not for stagflation over a medium run horizon.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lyons.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, October 13th. Our top stories today. Apple gets crunched. The global chip shortage is forcing the company to cut production of the new iPhone model by as many as 10 million units. Well, JP Morgan set the tone for Wall Street while the bank kicks off third quarter earnings for big lenders today. And Inflation Nation. The U.S. Consumer Price Index comes out a little more than 3 hours from now. Investors will, of course, look for signs that rising prices are more than just transitory. So, Kaylee, this will all play out in the markets. It's basically, on one hand, we're looking at earnings on Earnings Watch and Inflation Watch, especially in the U.S.
Yeah, there's a lot going on today, Francine, so buckle up and get ready. As for what the Asian session looked like overnight, broadly, it was positive across stocks, bonds, and currencies, by and large, at least. There were a few exceptions to that, including Japanese equities, which actually did fall on the day. But stocks were up in China, and actually markets were closed for stock trading in Hong Kong due to a typhoon. Now, a few individual equities to watch in the Asian session. Of course, Apple suppliers broadly were under pressure after that Bloomberg report last night that Apple is going to slash its production target for the iPhone 13 for the year due to that semiconductor shortage. So that weighed on equities like Japan Display, which was down the better part of 3% overnight. In China, though, you did see a big lift for some education stocks, some much needed relief for a sector that has come under regulatory pressure. And that was after China released new guidelines promoting vocational education. So that lifted shares including Kaiyan Education Technology up 20% in the overnight session. Two commodity stories to pay attention to, though. Of course, in China, you still have an ongoing power shortage as well as flooding in coal mines. That has made coal a very hot commodity, and futures rose to another record high today. But iron ore down about 10% in 2 days, down 4.5% today. A lot of concern about demand from steel producers. Now, as for the picture here in the U.S., we have about 2 hours until JP Morgan earnings and then 3.5 hours until CPI. So the market really just waiting and watching for that. Ahead of those key catalysts, though, S&P 500 futures are higher by about 0.2% after being lower earlier on in the session. And in the bond market, we are seeing yields coming in just a basis point on the 10-year Treasury, even further south of 160, right now at 156.47. The dollar is weaker on the day. And then I would point to crude after 8 gains in 9 days, Matt. We are looking a little softer this morning. WTI down around 0.5%, but still above $80 a barrel.
Yeah, you know, that softness, Kaylee, in oil and in other commodities also leading to losses on the FTSE. It's very heavily weighted with oil producers. So you see BP, for example, a big heavyweight on the FTSE down, as well as commodities producers, Rio Tinto and BHP Billiton also weighing on the FTSE. You can see the red there over the UK in the map. Elsewhere in Europe, we see gains, at least on the main benchmarks on the core, the CAC and the DAX are rising. But it kind of evens out in terms of the Stock 600, the broader benchmark. There isn't really a lot of movement there. I think the European market also really waiting for these bank earnings, waiting for them to kick off with JP Morgan. And then, of course, over the next 3 days, we have all of the major Wall Street banks reporting. And Europe really wants to see that cue. Europe also wants to see what's going on with inflation, and we'll get the CPI data out to show that. And it's really a tale of the U.S. leading the rest of the world in terms of not only bank earnings, but Fed policy, Francine. We need to see those data points.
Yeah, we absolutely need to see those data points, especially after we heard from Richard Clarida yesterday. And of course, as you're mentioning earnings, it's the big U.S. banks, but also we have LVMH giving a lift to some of the luxury sector in Europe. Now, look at what else is ahead today. As we were saying, JP Morgan actually kicks things off bank earnings-wise at 7 a.m. New York time. Traders await U.S. CPI data, which comes out at 8:30 a.m. New York time. A lot going on today. Then the G20 finance ministers and central bank governors will meet in Washington. And finally, Jeff Bezos' Blue Origin is scheduled to launch its second human spaceflight mission with actor William Shatner on board. So Apple likely to cut its projected iPhone 13 production targets due to chip shortages. Now, the company expects to make 10 million fewer iPhones than planned. I know Matt Miller wants to talk about space. We'll do that in a second, Matt, but let's get straight to Tom McKenzie, who's looking, of course, at Apple. Tom, good morning, first of all. My question is, if Apple, that has very deep pockets, can't get the chips, I mean, is there a chance for the rest of us?
Well, not just deep pockets, but also arguably the most sophisticated supply chain out there. And they'd lined up, they'd had a plan to deliver about 90 million units. This is the iPhone 13 within this last 3-month period. They're not going to do that. They're going to cut it, as you say, by 10 million units. Part of this is because the supply constraints from 2 key suppliers. So Broadcom, which supplies some of their wireless components, they are struggling to get the chips that they need for their businesses and their components to ship to Apple. But also Texas Instruments as well, which it develops its own chips, Texas Instruments, but it also relies on the likes of TSMC over in Taiwan, and they are struggling to get those components. So Broadcom, Texas Instruments supplying to Apple, that is where the constraints is now. The problem is that there's no short-term fix for this, even for a company like Apple that, of course, is fighting with the car makers as well for these components, the semiconductors. And the industry says, the foundries, the likes of TSMC, say this is likely to last until next year, possibly even further beyond that. And we're talking about lead times as well that continue to expand, around 22 weeks now, in terms of putting your order in and actually getting it delivered.
You know, you're the perfect person really to lead our tech coverage out of London, Tom, because you've just come from Asia where all these components are produced into the West where they're all integrated and then sold. What are we hearing in terms of component shortages and how much that weighs on Apple earnings?
Well, certainly the last 3 months of the year, they're expecting to generate revenue of about 120 billion US dollars. We'll see to what extent this plays into that, but we know already that the iPhone 13 Pro and the Pro Max, which went on sale in September, if you're buying them from the website and you placed an order in September when they went on sale, you're probably not going to get those phones delivered until for about a month after that. The carriers as well that partner with Apple also reporting that they're getting delays. The silver lining is that so far, according to the Bloomberg reporting, it looks like Apple should be able to make these deliveries for that all-important holiday season. But certainly, this has underscored that broader issue around supply chain constraints and the semiconductor issue specifically.
And we're seeing Apple shares lower by about 0.7% in pre-market trading. Thank you so much to Bloomberg's Tom McKenzie. And earnings season is getting underway unofficially today. JP Morgan reports its third quarter results before the market opens, with analysts looking for the lender to set the tone for big bank stocks. And lucky for us, we have our big banks guru, Sonali Basak, Bloomberg's Wall Street reporter, here with us. So Sonali, what are the key numbers you're going to be looking for out of JP Morgan this morning?
Well, very simply revenue, Kaylee, because it is expected to be down sequentially. Remember, we're not expecting trading to be as booming as it was in prior quarters. But with that said, JP Morgan a month ago has guided that it could be better than expected. So what exactly does that mean at the end of the day, and does it equate to market share gains on top of that? They have also said, Jamie Dimon just this week has said they're seeing some loan growth in some areas. And again, how many areas is what we're asking at the end of the day. And can it be sustained, especially as we look forward and expect that at some point we're going to see mortgage rates really rising, or people going to be borrowing as much in certain areas when the outlook is not as good for those products. So we'll see how it shapes up at the end of the day. Mixed bag.
Yeah, it seems like the really key question for banks is, do we see rates rise? Because it's so important to them, not only in terms of net interest margins, but also in terms of all the products that they buy and sell.
Yeah, I'll be looking for the outlook that they give. They have guided a little over $52 billion for the full year in net interest income. And should they revise that downward, that would be a very big warning sign to the entire industry. Now, Matt, with that said, the revenue declines that we may see at JP Morgan and Bank of America are not expected to be as steep as the ones that we see at the bigger investment banks, given that trading moderation. So at the end of the day, we'll be looking for color and commentary on what that means and what they're going to be able to invest at the end of the year when it comes to pay, technology, and bonuses.
All right, Bloomberg's Sonali Basak, going to be a busy lady for the next couple of days. Thank you so much for joining us. And we'll have more on bank earnings later this hour with analyst Allison Williams of Bloomberg Intelligence. But first, let's talk about a change coming at the Federal Reserve. Vice Chairman for Supervision Randall Quarles will be removed from his role as Wall Street Bank's main watchdog after his title officially expires today. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from our D.C. bureau. So, Anne-Marie, President Biden has yet to put forward a nominee for the new Vice Chairman of Supervision. What would his Democratic Party like to see?
Well, this also comes at a time when we're also waiting for that reappointment potentially of Chair Jay Powell.
What his party wants to see is definitely a lean towards progressives and more hawks when it comes to banking regulation. We knew that this position was going to be over for Randall Quarles. What is so interesting is that what the Fed has said it will happen continuously now. There will not be someone in the interim that will take on this role. This board will meet on an unchaired basis, and then if there's consensus, then it will be brought to the full board. So that was something that we learned that is new. But Kayleigh, to your point, this really has to do with the bigger picture. And one potential path forward for the president, what his advisors are talking about, and Bloomberg previously reported, is that to really be able to check boxes of everyone that is involved is to potentially put someone like Governor Brainard in this post, really a little bit more hawkish on the banks, tougher on regulation, but keep Powell at the top job. But again, we still do not have any indication yet from the White House of what exactly they're going to be doing.
And Marisa, at the same time, the House cleared the short-term debt cap increase, kicking it to December 3rd. What's the next negotiation?
It's, Francine, as you say, it's just basically kicking the can down the road. This is a Band-Aid. And what's so interesting about the timeline of this increasing the cap by $480 billion is that it now coincides with also the extension and that timeline for the stopgap funding measure. So this means on December 3rd, Congress needs to take action again, not just regarding the debt ceiling, but regarding keeping the government open and those appropriations being paid by the U.S. federal government. So it sets down just another showdown for December 3rd. What we have learned, though, is that the Republicans who allowed a little bit more of an easy path forward for this minor Band-Aid for the debt ceiling, Senator Mitch McConnell says they will not do so again. So the Democrats are back to square one. Are they going to go via reconciliation, or Speaker Pelosi says that she wants it to be done on a bipartisan basis, or potentially she even floated the idea of looking into the Treasury itself, just moving the caps, and then the Congress just voting if they don't agree with the movement from the Treasury. That potentially could get rid of this debt ceiling drama that has really just plagued both parties for years.
And we get fresh drama anew in December. Bloomberg's Anne-Marie Gordon in Washington, thank you so much. And now let's get back to the markets and take a look at some stocks moving in pre-market trading in the U.S. One of the bigger movers to the upside is Plug Power, which of course makes EV fuel cells. It is higher by the better part of 4% after getting upgraded to overweight at Morgan Stanley. The analyst putting a $40 price target on the stock. Is trading around $31 a share this morning. To the downside, though, is CRISPR Therapeutics, and this is after it released results from an early stage trial for its blood cancer therapy. Those results disappointing investors, and as a result, the share is down 5.5% in pre-market trading. And of course, we were just going through the Apple story with Tom McKenzie potentially cutting its iPhone production targets for the year. That's not just weighing on Apple this morning, it is also weighing on its suppliers, including Skyworks Solutions, which gets about half of its revenue from Apple. It's down about 2.5% before the bell, Francine.
Kelly, we'll have plenty more, of course, on some of those stocks. Plus, also coming up this hour, not so transitory, the Atlantic Fed President, Raphael Bostic, says inflation is broadening and lasting longer than expected. Then Jane Fraser has a plan to remake Citigroup. We've got the big take on Fraser's new strategy, plus an exclusive conversation with the Standard Chartered Chief Executive Bill Winters. He gives his take on innovation in the digital banking space. That's all coming up a little bit later. This is Bloomberg.
The Greek economic debacle. What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic. but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop,
look
drop
great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
It is becoming increasingly clear that the feature of this episode that is animated price pressures, mainly the intense and widespread supply chain disruptions, will not be brief. Data from multiple sources point to these lasting longer than most initially thought. And by this definition, then, the forces are not transitory.
Very interesting stuff there from Atlanta Fed Chief Raphael Bostic, saying inflation is broadening and lasting longer than expected. We've got a chart from the New York Fed, and for those of you joining us in London DAB Digital, I'll just walk you through what we've seen. Expectations from consumers are rising at a record. This survey, I believe, from the New York Fed is about 8 years old, and we're at the highest level that we've ever been. In terms of one-year inflation expectations, 5.3%. So it's a lot more than the target, more than double the target, almost triple it. Mark Cudmore, Bloomberg macro strategist, joins us now. Mark, how concerned should we be, or is the market getting more and more concerned about inflation?
Absolutely. We've been talking about inflation all year, but I think more people are starting to realize that, as Bostic says, transitory really is the wrong word to use. It is a dirty word. I love the way you had a swear jar there. I'm just a little bit upset that you cut the clip off before we saw him put money in it. But I think ultimately the Fed has backed themselves into a corner, right? They keep on talking about transitory. And that's a very, very loose term. And that's what we're struggling to define. What is transitory now? People are talking about whether it'll feed into medium-term expectations, which could be an 18, 24-month horizon. The Fed has been boxed in by transitory. It's dangerous. They need to back away from it very, very quickly without panicking the market. But clearly, the market now realizes that even if you think transitory still means it's not permanent or not persistent, it can last a lot longer than we thought a few months ago.
Mark, how much of a repricing could we see in asset classes because of that CPI print? Like, what exactly is priced in right now?
So, I think that today, well, I mean, 5.3% of the expectations year on year, I'm not going to kind of say it's pricing it much different. I actually think today's print is important only because of what's happening this week or two. But remember, this is not the print that's capturing these oil price moves. So in many ways, today won't be the real big inflation print. It's actually, we're worried about what the inflation print is going to be next month, which is why we're focused on this one. It's all about the breakdown today. So it's not the headline number we're going to care about today. It's all about whether there's other factors that are suddenly moving to these supply chain problems.
But Mark, to that point, what we're going to be focused on is the core CPI print, which backs out food and energy, where a lot of these inflation fears have stemmed from. Do we need to start thinking about it differently and care less about the core?
I know, I think ultimately core is very, very important. But the only reason I say look beyond the core, still care about the headline, is that, look, I think this is becoming a big enough problem. It's not, you don't want to take the economist take. The economist take is this is transitory, and that's where central bank's going to go, this is transitory. The problem is we are seeing big enough headline prints month after month that are just in those papers that people open up every day that they say, I'm reading about 5% inflation. I want a wage hike that makes me afford that. I want my 10% wage hike. And that's how you get a persistent inflation problem. So I think it's because we're getting consistently high, not persistently high, consistently high headline inflation, that feeds through to Main Street, and that's when you have a real inflation problem. And that is why I think we need to stop being so academic about it and looking at the core, and we need to start saying what the narrative is.
Right. I mean, if you look at the narrative, Apple, with deep pockets, a great supply chain, just can't deliver enough for iPhones because of the chip shortage. I mean, does that permeate through everything if it touches Apple?
I think that's right. You know, like the biggest company in the world, everyone's like, well, iPhones don't even get, aren't invincible from kind of supply chain issues. And I think that's, again, when the man in the street kind of goes, oh my God, am I going to be able to get presents this Christmas? And they start buying up more problems. They create more of a backlog. They start bidding up for stuff. Look, it's really, really important that the only way you get an inflation spiral is because everyone believes it's going to be an inflation problem. The way everyone believes it is because it hits the man in the street. This has gone beyond analyzing it academically. We need to think about what people in the street, how they're reacting, what the news stories are, and that's why Apple matters.
Mark, in 2 seconds, should I be buying Christmas presents now? Yes or no?
Yes.
Yes. Oh my goodness, I'm already late. Mark Cudmore there.
You know what I want for Christmas, Francine? I want Mark Cudmore to stay forever. Can you just stay on our program? Can you just stay there?
Santa, please.
I'm no answer to that one. I'm dumbstruck.
Okay, as his chief spokesperson, he is staying. For more market analysis, you can also check out Mark and his team on MLIV Go on your Bloomberg terminal. This is Bloomberg.
Morning traders, how are you today? I'm going to place an order to buy euro. The price I'm looking to buy 115, 52.3. Okay, order placed 115, 52.3. Position opened right now. You still have chance to buy because it moved lower. Right now 52.1. So if you want to trade euro against United States dollar, please copy this trade, follow strategy you got, and we will collect the profit. Okay, for new people who doesn't have a strategy, you need to get from company.co.uk strategy and start following my trades, copy them, practice for a couple of weeks, and you can trade other securities as well, like indices, stocks, shares, lots of other on margin instruments, derivative instruments like forex, indices. Okay, stay safe, guys. I'll speak to you later.
And competition, but so far the cannabis sector seems to be holding up very strong.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Well, this is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now let's get straight to the Bloomberg First Word News on China's exports surged to a new monthly record in September. Strong demand in advance of the holiday shopping season outweighed the effect of power shortages across the country. While rising prices also added to the increase. Meanwhile, China's imports rose less than expected. Vladimir Putin sees Europe's natural gas crisis as Russia's golden opportunity. The Russian lender wants the European Union to rewrite some of the rules of its gas market after years of ignoring Moscow's concerns. While Russia is also seeking rapid certification of the controversial Nord Stream 2 pipeline to Germany to boost gas deliveries. And Netflix says the South Korean show Squid Game has become its biggest series launch ever. The dystopian drama has attracted 111 million views since its release September 17th. That surpassed Netflix's previous top show Bridgerton, which hit 82 million households in its first 28 days of release. Some of us like it, some of us don't. Michael Burry's profitable bets against the housing bubble were immortalized in The Big Short. Now the doctor-turned-investor has gone on a Twitter rant against taxes, while Burry denounced what he calls U.S. class warfare, and he challenged the notion that the rich don't pay enough taxes. I mean, I guess some people say it's quite refreshing after many billionaires, came through saying that they want to pay more taxes. I'm thinking, of course, of Warren Buffett.
Well, he's welcome to pay more taxes. There's no law saying that he has to pay the bare minimum. He can write a much bigger check anytime he likes. And look, I think regardless of which side of the argument you're on, a lot of people feel like the U.S. tax system is flawed. The code is like 50,000 pages long. Nobody understands it. And it could be simplified were it not for people who work in Washington.
Well, and Matt, we know President Biden continues to repeat the refrain that the rich should pay their fair share. I guess the question is, what exactly is the fair share? It seems like that's relative, Francine.
Yeah, maybe we'll talk also about that 50% tax deal worldwide. Coming up next, Trevor Greetham, head of multi-asset at Royal London Asset Management. This is Bloomberg.
As Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Katie Lyons in New York. Matt, the focus firmly on inflation, although it probably won't account for some of the energy prices, as our Mark Cudmore was saying, because it's backward-looking, and the focus, of course, on earnings.
Well, and we never got to touch on Squid Game. I just want to point out that I think a lot of people have watched this program. It's quite good, in my personal opinion. I'll editorialize a little bit here. At the start, and then it becomes so bleak and dark and depressing and dystopian that it just left me feeling really bad at the end. I feel like a lot of people would agree.
Markets. Yeah.
No, Did you watch the whole thing?
You know what? I didn't watch the whole thing. A lot of viewers actually watch it like through their hands. A little bit gory, and they're kind of like watching it like this, saying I'm enjoying it, but also it's very, very gory. But it's a stellar program for Netflix, Kaylee.
Yeah, and what's interesting is Netflix can do this, but our Tara LaChapelle of Bloomberg Opinion has pointed out that this is something that Disney Plus could never do because it's family-oriented, and that kind of shock factor and gore just doesn't work. So it really goes to the competition between the different streaming platforms and the content that they can put out there into the world. But I'm going to get us back on track, talk about the markets. We do have CPI data and JP Morgan earnings today. Going to be a big day, and ahead of those potential catalysts, we are seeing stocks right around session highs in Europe. The Stoxx 600 now higher by about 0.5% after being in negative territory earlier in the session. And when it comes to S&P 500 futures, they too are in positive territory, up about 0.2%. In the bond market, we are coming lower on the U.S. 10-year yield. We're just under 1.56% at the moment. And crude oil is off of session lows, still though down about 0.33%. We hold north of $80 a barrel. Now, as for some individual company stories we're watching today, the big one really is Apple after that Bloomberg report after the bell yesterday that it is looking to potentially cut its iPhone 13 production target for the year thanks to the semiconductor shortage. So as a result, Apple is down about 0.6%. You're seeing some suppliers like Skyworks Solutions under pressure as well. It's down about 2.5%. And then just a quick check on JP Morgan ahead of its report at 7 a.m. Eastern time. Right now down about 0.1%. But then an hour and a half later is really the big inflation print we get today. The CPI data will be out at 8:30 a.m. Eastern time. What kind of pressures will we see from rising energy prices, and what does that mean for the outlook for monetary policy? Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now for more. So Mike, give us the down low.
Well, Casey, it's very easy to explain the CPI report today in terms of this chart here, because this is the white line CPI, the yellow line CPI core. And the question is it going to be this or is it going to be this? We saw in August that CPI slowed. It still rose, but it slowed. And the question is, does that suggest transitory going forward? Now, this is inflation that's too low. This is inflation that's too high. So the Fed gets their average. And yesterday, the Vice Chairman, Richard Clarida, said we have more than met the inflation mandate in order to be able to start tapering. So if we get a little bit of a decline or even flat, which is what's forecast today, 5.3% on a year-over-year basis for the headline and 4% for the core, then it's going to be for Wall Street, all systems go for a taper in November. The other question is this one. Do we see these particular items continue to go down? These were the transitory ones that the Fed has been talking about: used cars, car rental, airfares, hotels, motels. Keep an eye on the white line. That's used cars. They were going down, as you can see, and they've started to go back up again. What is the persistence of inflation? We'll be looking at that.
I've got a few used cars to sell, so I hope that line continues to head north. I wanted to get your take on stagflation, Mike. You know, transitory seems to be the word of yesterday, and stagflation is the one on everyone's lips today. What's your take?
I don't think we're going to see stagflation. Rich Clarida asked about it yesterday. He said, this is not the 1970s. We are seeing more inflation. There is a feeling among most economists that inflation will back off, but the most important side of this is the stag. We are still seeing a lot of growth. This quarter, not good, but for the year, we're going to come in about 6%. Next year, the forecast is over 5%. That's not stagflation. Stagflation would be if we were growing about 1%. I might mention, though, food. Keep an eye on food costs. Today, Foshan Haitian, which is China's largest soy sauce maker, said they were raising prices. So your Chinese food may cost more.
Michael, thank you so much. Our Michael McKee there with the very latest on inflation, including food. I know coffee prices went up some 20% worldwide now. Joining us to talk about all of this is Trevor Greetham, head of multi-asset at Royal London Asset Management. Trevor, thank you for joining us. If you look at some of the wage pressures, if you look at inflation in food and elsewhere, how can this be transitory?
Well, in the long run, everything's transitory. The problem is that this inflation sticking around for longer than people were expecting, and partly that is the supply shortages we're seeing. It's some of the underinvestment in commodity industries means you're hitting some spikes in things like natural gas and Chinese coal. So you've definitely got a lot of extra inflation pressures at the moment. Next year, you'd expect inflation to come down a little bit, but at the moment, the markets are focused on this unfortunate combination of inflation that's high and, if anything, rising, and growth, which is slowing down. So take a bit of exception in the idea that growth is clearly a strong story at the moment, because the reopening has caused this massive growth, and now we're waiting to see what the next trend is, and we don't know yet. We're more optimistic about US growth than we are about European growth or Chinese growth in that respect. But at the moment, in our investment clock, we are in stagflation. We've got inflation rising, growth is slowing.
So, Trevor, what does it mean for actually your asset allocation? What are you buying right now?
Well, all year we've been most overweight commodities, most underweight government bonds. Regionally, we're tilted away from emerging markets in China. We think the property slowdown carries on, so we're overweight the US, the UK market, which has some inflation resilience, and also Japan, which tends to do well when US Treasury yields are rising, because you get a weaker yen, and that helps the Japanese exporters. Then within sectors, it's financials and energy. So we've got that value tilt on. Recently, we've taken some profits in some of those positions, and we've gone from a neutral position in equities at the market high to a small to moderate overweight, because our investor sentiment measures do show quite a lot of panic. And we think that although we've got this slightly difficult macro environment to get through over the next few months, there will be an opportunity to buy shares ahead of 2022, which should be a better year, particularly in the US. But we just don't know how long this workout period is, where the market is so soggy. We're buying the dips and selling the rallies for the time being.
Do you worry about hedging against inflation, Trevor? And if clients want to do that to some extent in their portfolios, what do you recommend?
Well, we recommend they invest with us. Yes. Joking aside, we've had a bit of a sort of a crusade against the oversimplified balanced funds. So 60-40 fund, 60 global equities, 40 aggregate investment grade bonds, very sensitive to rising interest rates. Did really well in 2020 because tech went through the roof and bond yields dropped. But you're really exposed in a balanced fund. You need much more diversification. So we've got UK commercial property that's heading for a 12% return this year. We've got commodities that in sterling terms are up about 20% this year. We have a bigger allocation to UK equities than the market cap weighting. And that gives you extra inflation resilience because of the sectoral makeup. So yeah, you can get a more resilient portfolio to inflation, but a 60-40 balanced fund doesn't do it for you.
Yeah, Trevor, you're echoing what Bank of America has said recently, calling for the end of 60-40 because we're seeing both stocks and bonds falling now in tandem. We also have JP Morgan earnings coming up aside from the CPI print later on this morning. If earnings do not surprise materially to the upside, what does that mean for the equity market in the end of the year?
Well, I think you're going to see some gradual disappointment on earnings and also some downward guidance. And that's part of the reason why I think we're in this sort of more turbulent, soggy period for markets. Because if you look at economic surprises, they've already turned negative because the big reopening trade has matured. And now you've got the sort of steadier growth profile. So economic surprises are negative. And I think we'll see earnings surprises negative and some negative guidance as well. But beyond that, I'm expecting higher long-end yields, and that will benefit net interest margins at banks. But I still think US banks are an overweight sector.
Trevor, thanks so much. Trevor Greetham there, head of multi-asset at Royal London Asset Management. Now, coming up, JP Morgan kicks off US bank earnings today, so we'll get more exactly on what we should be expecting. This is Bloomberg.
Essa população é uma população importante, é uma população que frequenta a escola também, né? Então é importante que eles também estejam protegidos para o coronavírus, evitando assim a transmissão.
Eu estava esperando muito por essa vacina. Desde o ano passado eu estava torcendo logo para poder minha vida logo voltar ao normal, que eu quero logo voltar para a escola, eu quero voltar a sair com meus amigos, eu quero sair, eu quero voltar à minha vida normal. Foi toda administrada.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Do I see persistence in inflation? Yes. I believe it's more than transitory related to supply chain issues and commodity prices.
Hopefully it will straighten out over the next 6 months. History would show it should. If the supply chain holds people back from certain goods, they find other places to spend it.
People are very, very confident that, they are transitory, that they will be solved. And whether it's 3 months, 6 months, 9 months, I don't know. I don't think it'll be longer than that. So, I am confident that we will get past this.
That was various bank CEOs weighing in on global supply chain issues. They spoke from the Institute of International Finance's annual meeting yesterday. And speaking of banks, let's get more on the earnings this week, which of course kick off with JP Morgan later on this morning. Allison Williams, Bloomberg Intelligence Senior Global Banks and Asset Managers Analyst, joins us now. So Allison, the story for most of the pandemic has been that the investment bank drives everything, and loan growth has been very hard to find. Did that change in the third quarter?
We'll see, and I think that is the number one question. Normally, there are certain things that we track throughout the quarter. We do look at Federal Reserve data, but the picture's been a little bit clouded for a couple of key loan categories. So the number one for JP Morgan today is going to be what's happening with card. So if you look at credit card loans and if you look at the aggregate numbers, balances are improving and loans are growing. But what we've heard over the last couple of calls is that a lot of that is not necessarily interest earning. So if you spend money on your credit card and you pay it back, you're not paying interest. That's not contributing to the bank's net interest income. And so what we heard from JP Morgan in September was that a lot of the higher payments, the elevated payments, had come down and things were stabilizing. So we weren't yet calling it an inflection, or they weren't calling it an inflection yet, but things stabilizing. However, from Citigroup, we heard those payments are still a little bit elevated. So we're going to want to see if we're getting loan growth. And again, the key is really not this quarter. The key is the outlook for next year. And so the banks and the industry in general has been looking for loan growth to improve coming into the back half. And so that's guidance has gotten a little bit weaker. Some of the trends have gotten a little bit weaker.
So,
there's still been a little optimism, but I think people need a little bit more to keep that optimism.
Yeah, so forward guidance going to be really, really key in the commentary, at least on the conference call. When it comes to trading, you mentioned we heard from JP Morgan in September. They also said it's going to be down, but maybe not quite as hard as we expected. What exact numbers are you expecting to see?
So in general, we're expecting trading overall to be about down 10%. We do think there could be some upside on the equity side of things. So the positive side for equities has been the very strong initial public offerings that we've seen. So obviously when there's IPO strength, that leads to a lot of secondary trading activity. So we do expect some modest growth there across the banks. The key story, of course, is going to be market share. We had Credit Suisse pull back in the prime brokerage business. We think Bank of America and Citigroup are trying to come in, as well as other competitors, and gain some share there. Fixed income trading, on the other hand, should be down, probably 15 to 20%. Again, we're talking about versus a very strong year last year, and I think the positive news for the banks is the fact that revenue is better than it was in 2019. So worse than last year, but still better longer term.
Alison, our front cover star for Bloomberg Businessweek is Jane Fraser of Citigroup. Now, in an interview with Bloomberg, she says a lot of the U.S. models are actually broker-driven, which she says will be obliterated in the years ahead. Like, if you look at all the U.S. banks, how will they change in the next 5 years?
Well, technology is going to be the biggest change driver. I don't think I'm unique in that view, but I think that is going to be where I think a lot of the competitive battleground is going to be fought. And so we're well familiar with a lot of the trends on the consumer side of things, right? So digital banking, especially during the pandemic, a lot of acceleration in things like mobile deposits and using your phone. But the banks are also doing a lot of things on the institutional side. Those that have invested in the business, like JP Morgan, as an example, Goldman Sachs, have really leveraged that in their trading business. Bank of America also, even yesterday, had an announcement on some of the things that they're doing on the corporate side of things. And so I think that is going to change. And then for Citigroup, as I said earlier, one of the opportunities that we see for them near term is equity trading, but Jane, I think, is really reshaping the bank. I think just bringing more visibility to their wealth business, which they have a very strong Asia presence, and I think the move away from transaction and towards fees is something that the banking industry has been headed towards for a long time.
How important is the U.S. savings rate? And it's not just the U.S. where we see savings rates stabilize at a higher level than they were pre-pandemic. This must have an effect, Alison, on loan demand.
And that is, that is the key point, as some of the conversation we were having earlier in terms of the credit card business. So because of all the stimulus payments, consumers have money and they're paying off their credit card balances through their savings instead of borrowing. So that's a great thing for the consumer. It's great to have a healthy consumer and the consumer is spending, and so all of those metrics are positive. It just leads to a little less on the interest income side. And so that has been one of the key implications of all the liquidity, consumers and corporations with a lot of cash.
Alison, thank you so much. Alison Williams there of Bloomberg Intelligence, looking at the banks now. Stay with Bloomberg TV and radio for full coverage and full analysis as JP Morgan, of course, kicks off the banking earnings parade a little bit later this morning. This is Bloomberg.
OECD nations need to end coal use by 2030. Developing nations need to follow suit by 2040. And we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance, early edition. I'm Francine Lackman, London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, the chief executive of Standard Chartered says that his bank is doing a great job of innovating internally, but shareholders won't take into account the value of fintech within big institutions until it starts to show a profit. Well, I caught up with Bill Winters yesterday.
I think what we're seeing right now is that the biggest fintechs are actually happening within banks. Now, they get lost in the context of the bigger bank, but when you look at the amount of deal activity or transaction activity that's going through some of the very high market value fintechs right now, it's actually quite small relative to the identically digitally driven volumes that are happening in banks. But because they're not very profitable, and we see that from the profitability of fintech, I mean, most of them aren't profitable at all. And certainly inside banks, they're no more profitable at this stage, maybe a little bit more profitable if we can get to some scale quickly. But they're not turning the dial in terms of your bottom line operating earnings, and therefore it's not finding its way into value. But the relevance to customers is very clear. And it starts with the things we all know about, which is small value payments. The fintech industry disrupted small value payments. Banks have quickly caught up, including cross-currency, small value payments, so remittances and cross-border payments. And that's I think banks are delivering that quite well. The fintechs are super creative, and they're well-funded, extremely creative, and very fast. And don't have the legacy infrastructure that the banks have, and probably don't have quite the same regulatory oversight, although our regulators would never acknowledge that.
Well, that was part of our exclusive conversation with Standard Chartered Chief Executive Bill Winters. Now let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance. Tom, I know you're a keen inflation watch. The thing is that with the CPI that's coming out today, it won't necessarily take into account all of the energy crunch we've seen.
Well, the energy prices may not be there. It is a busy, busy Wednesday. We're here in Washington, Francine, the IMF World Bank meetings. They are different meetings after the pandemic. They're definitely, Francine, not back to speed. We've got the bank earnings as well, and an inflation report, which dovetails with the retail report coming out in a few days. This chart explains it all. The suits and ties in Washington, the fancy economists all say inflation's transitory. The reality is the white line and the circle way up top, which is all the agony. Every single person I met, Francine, on the airplane, every single one asked me about inflation. And then you come down to the normal other inflations like the Dallas trim mean and the Cleveland inflation level, and that's where the economists claim we are heading back to.
Yeah, it comes from wages. It comes also from food inflation. Tom Keene there, co-anchor of Bloomberg Surveillance, joining us from the IMF meetings. I'm excited about your interviews, Tom. Now, here is a look at what else we're watching. Kaylee, all over the JP Morgan earnings.
Yep, those are coming up around 7 a.m. Eastern time. As we were just discussing with Allison Williams, it's going to be about loan growth predominantly, which has been very hard to find during the pandemic era. And then also, of course, we're looking for trading to decline because of tough comps. And we'll be watching advisory fees as well because deals are really quite hot. The question for me, Matt, is this is a stock up 30% year to date. The banks as a whole up 35%. So how much good news has been priced in? And is that rally going to be supported by the fundamentals we get today and through the remainder of the week?
Yeah, we'll be paying very close attention to that. And I, of course, I'm always paying very close attention to cars. I woke up this morning to a piece in Handelsblatt about the CEO of Volkswagen, Herbert Diess, saying he sees a risk of 30,000 job cuts. Now, what really happened is he told a supervisory board meeting September 24th that would be one scenario, and we know that building electric cars requires fewer people on the factory floor, and we also know that Diess and Volkswagen are hiring a lot more people to write code, to write software, to develop batteries. So it's not like the gross cuts would be, or the net cuts would be 30,000, but apparently the supervisory board told him not even think about big job cuts like that, and they have an agreement with the union. I just thought it was very interesting.
It was very interesting. What's also very interesting is the Blue Origin lunch. It's a little bit later today. Now, it was initially meant to be yesterday, but it was postponed because of bad weather. Yes, yeah. William Shatner, 90 years old. Of course, the Star Trek star going into space equipped with artwork that Jeff Bezos made to play Star Trek when he was 9 years old, and a postcard also to inspire the next generation. It'll be quite a fun watch.
Yeah, very cool. I can't believe he's 90 years old. He looks great. 90
years old. Yeah, and going into space. More Bloomberg surveillance up ahead. We'll hear from the IEA director, Fatih Birol, and Joseph Stiglitz, amongst others. This is Bloomberg.
Blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and like what changes they are actually bring to this market.
It's a difficult market to navigate right at the moment because you do have this sort of stagflation narrative.
This right now, we're seeing narratives that are completely new to us.
Households are still flush with cash, and
and businesses are flush with cash.
This conversation around slower retail sentiment, slower retail sales, very much is feeding into why inflation eventually will come off.
If your sort of question is simply, is growth going to slow next year? The answer to that is a resounding yes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The week begins right now from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. This Wednesday morning, equity futures positive 0.2%. Tom Keene, JP Morgan earnings this hour.
Bank earnings are really front and center for me, John. They get us going, and what's so important here is going to be the conference calls, the nuances of what they say. Not only what James Dimon says, the 3 banks, 4 banks tomorrow as well. And then, John, we dive right into those important tech earnings the end of October.
And before we get to CPI, we need to talk about Apple. Let's do that right now. Fantastic reporting from Debbie Wu out in Taipei. That stock is negative, just 0.6%. We can talk about that in just a moment. Here's the quote from her lead paragraph, Tom. Apple is likely to slash its projected iPhone 13 production targets for 2021 by as many as 10 million units. The why? Because they can't find the chips.
I've heard this from T-Mobile. My carrier's T-Mobile, and they've said the same thing to me, John. They're having trouble getting the phones. There's 2 things going on here. One of them is a shortage that Debbie reports. Mark Gurman's been out in front of this as well. But, John, the other thing is they're selling the units. People want the new toy. Anurag Rana and our team at Bloomberg Intelligence say the demand's at least 6.5%. better than consensus.
Lisa, you can learn something from the Bloomberg story. You can also learn something from how the market responds to the Bloomberg story. That stock, that's not a big move. We've had the big move over the last month.
Yeah, it's down almost 10%. Basically, you've seen a correction already in the Apple shares. What I find interesting is actually what Morgan Stanley analyst said about the potential cut in production estimates, basically saying if Apple can't meet near-term demand, well, it doesn't speak very well for their competitors, and it might mean that they can actually win market share, sort of the dynamics underpinning this idea.
And what do you think Wedbush has got to say? Tom Keene, this is from Dan Ives over at Wedbush. We view today's news as nothing more than a speed bump on a multi-year super cycle iPhone 12, 13 that continues to play out.
This is so important. John, I was thinking, coming over in the Bentley, I was thinking here, John, in Washington, about our time frame. And the answer is, in the narrative moment of October this year, everybody's working on short narratives where Dan Ives is out looking multi-year. Maybe we can be multi-year on bank earnings today.
We'll try and do that, expecting those numbers to drop at about 6:45 Eastern time. So in about 43 minutes, Lisa will run you through the day ahead. Here's the price action as we kick off things this Wednesday. Equity futures positive 9. We advanced 0.2% on the S&P. On NASDAQ 100 futures, we're positive by 0.5%. In the FX market, euro stronger, dollar weaker, euro dollar 115.59. Transitory is a dirty word, Tom. Dirty word. In the bond market, yields in a basis point. 156.64. Tom, just pick up briefly on what's happened with the bond market in the past 24 hours. That curve is flatter.
Yes. First thing I noticed this morning, John, we're on the same wavelength from Washington to New York. Oh, my God. 210 spread comes in 122 basis points. I'm sorry it's germane. It really matters, John, that these yields have come in pushing against the gloom of higher yields.
Lisa, this curve is flatter going into CPI.
The idea here being that I don't want to call it stagflation because evidently that's a dirty word as well, but I'll call it slugflation. Thank you very much, Doug Cass. The idea here that faster inflation right now and supply chain disruptions will actually materially slow growth going forward, a la Apple cutting production and therefore taking a chunk out of GDP. Today at 8:30 a.m., to me, I am fascinated by this number, U.S. September Consumer Price Index data coming out. The expectation broadly is for 5.3% year-over-year increase. Bloomberg Economics expects it to rise back up to the highest level, 5.4% since 2008. This has to do with energy prices. This has to do with housing prices. This is not the kind of inflation that can lead to a cycle because it's not being driven by wage inflation, which is the reason why you're seeing that flattening in the yield curve. Then at 9 a.m., IMF Managing Director Kristalina Georgieva talks ahead of the 2021 annual meetings. You have lots of people gathering in Washington, D.C., financial leaders, central bankers, Tom Keene, everybody there trying to talk about the road ahead, especially as the U.S. and Europe lose economic clout. How do you give more economic clout to the behemoths of the likes of China, especially with the credibility gap that is increasingly growing among a lot of the policymakers. And then later on today, 2 p.m., we get the FOMC meeting minutes. This, of course, has to do with the balance sheet. When do they start tapering the $120 billion of monthly bond purchases? But it also has to do with the rate hike idea. 2-year yields right now at the highest levels that they have been since the height of the pandemic. John, people bringing forward rate hike expectations despite the fact that transitory is a dirty word with a swear jar, despite the fact that Treasury Secretary Janet Yellen says it still is actually in effect, and this is transitory.
The Atlanta Fed President Raphael Bostic making a headlines in a big way yesterday. Yes. Lisa, thank you so much. Tom Keene, what's in store down in Washington?
What's in store in Washington is damage control at the IMF. John, I've been doing this for decades, and it's not as big a deal as it was 20 years ago or 15 years ago. It's not that it's jumped the shark, it's a different meeting. Within that is what Gita Gopinath said yesterday in the World Economic Outlook, and all eyes are on the managing director and how she is going to come out of the uproar that she's had at the World Bank in her 90-day tenure there a number of years ago. And I'll say, John, the jury's out.
Looking forward to the coverage, Tom, through the next couple of days. Joining us now is Greg Bowdle, BNP Paribas US Head of Equity and Derivative Strategy. Greg, let's start right here. We talked briefly about Apple, down 10% from the September highs. Let's talk about the banks. They're up almost 10% from September 22nd. What have you told clients about how to manage exposure to that industry group going into earnings?
Well, thanks. I think that banks are, interestingly, one of the few sectors this year that have got more expensive rather than less expensive. We've seen such strong growth from things like the large cap tech sectors that although the share prices have done well this year, they've actually got cheaper on a headline P basis rather than more expensive. The banks, in contrast, have got a bit more expensive. So we're a little bit cautious coming into these numbers, concerned a little bit about the sustainability of revenue growth and starting to ask a little bit of questions about cost growth.
So what's the most important thing, Greg, for you to see to get more bullish on the banks? Is it simply the yield curve, or is it, say, consumer loan growth, corporate loan growth, things that we have not necessarily seen, certainly to analyst satisfaction so far?
I think the yield curve is extremely important, obviously, but it's more about its medium-term trajectory rather than where it moves in the very short term. I think for a kind of constructive bullish case on the banks into next year, then it has to be much more about the sustainability of loan growth. But I think it's not really about whether banks beat or miss numbers this quarter. It's more about what's driving the beat or miss. Is it something more sustainable, something that you can project forward, like loan growth, or is it going to be more due to provision releases or trading revenues?
Greg, let's go to the heart of your work at BNP Paribas, which is on positioning the bets that people are making within the equity market. Is there an overweight in banks right now? Are people up to their eyeballs in bank shares or not?
Yeah, so I think one of the things that we've been talking about for this past quarter is that we think positioning generally for
okay, guys,
are more fragile.
It's time to play stop on profit. All of you guys who hold in the strategy, you know what to do. You have to play stop on profit, 5 pips above. 115, 57.3. Okay, here it is. 115, 57.3. Okay, guys, speak to you later.
Margins a little bit and slow top line growth. But I think importantly, our economics team don't believe this is something that's really going to continue into the bulk of next year. So what we're focused on more is a tactical correction for equity markets, and we're looking for a robust year next year, but maybe some short-term bumps in the road before we get there.
What's the leverage right now in the market? What are the hedge funds doing?
Yeah, so we think the leverage is still pretty high. We saw some outflows over the last couple of the weeks as the market has corrected. But this is coming off a year where we've seen absolutely massive inflows into equities. Importantly as well, we think some of the dynamics around the options market has changed. You know, dealers have had this very long gamma position that's been suppressing daily moves in the market. The move lower that we've seen over the last 3 or 4 weeks has taken us away from some of that positioning and has left us in a configuration where the market is freed up to move a little bit more actively. And importantly, some of the quantitative strategies, things like vol target funds that act more mechanically, have become marginal sellers in recent weeks rather than marginal buyers as a result of that higher daily volatility.
Hey, Greg, thank you, sir. We've got to run. We've got to leave it there. Always good to catch up, going into earnings season, particularly so. Greg Bowdle then, BNP Paribas Head of Equity Strategy. Looking at the banks, JP Morgan, Tom, coming up this hour, then on to tomorrow. Bank of America, Citi, Morgan Stanley, Wells Fargo, on to Friday. It's Goldman Sachs.
John, can I mention the correction that Mr. Bowdle just spoke about? The Standard & Poor's 500 is down 4%. I can understand within that there's some corrections going on, as there always is, but John, we've lost total perspective on what down is.
Well, have we been conditioned by what down is and what down has been over the last 9 months, Tom? Isn't that the story here? That down has been 3%. Buy it. Down has been 4 or 5. Buy it. You get conditioned by that, Tom.
You get conditioned by it, but to me, it's the elephant in the room, which is just an absolute wall of money out there, including the banks like J.P. Morgan, parking it all in the overnight market. I mean, out well over $1 trillion. I think going into J.P. Morgan, which, frankly, folks, I learn a lot from what J.P. Morgan says. And John, I would suggest we don't gauge how unusual these times are.
I would agree. Going into JP Morgan, let's talk about one key issue. Lisa, it's loan growth. We had Mike Mayo of Wells Fargo in a Bloomberg story saying the following: loan growth is almost certainly around the corner. It's a soft inflection point. If loan growth were a car, there's always something like this in there from Mike Mayo, isn't there? If loan growth were a car, it has gone from reverse to first gear, perhaps moving in the right direction.
Well, this is so important, especially at a time of waning consumer confidence, at least by the University of Michigan survey. Do consumers want to borrow money when they still are flush with cash? If they don't, where is the source of growth for banks?
We are expecting JP Morgan numbers this hour. That's going to be a part of the conversation for us. Then through the week, Bank of America, Citi, Morgan Stanley, Wells Fargo, onto Goldman. Before we get to tomorrow, CPI 8:30 Eastern Time. The week well and truly starts right now. Equity futures up 9. We advance 0.2% from New York City and from Washington, D.C. too. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. On Capitol Hill, the House has approved a short-term increase in the government's debt limit. Lawmakers are sending the legislation to President Biden just days before the Treasury was at risk of running out of borrowing authority. Still, what that means is there is likely to be another partisan confrontation over spending and debt in less than 2 months. Next month, the U.S. will relax coronavirus restrictions at its land borders with Canada and Mexico. That will allow for the resumption of non-essential travel like tourism. The move comes after the White House said it would start allowing airline passengers from a wide range of countries to enter the U.S. with proof of vaccination and a coronavirus test. The European Union will offer a new round of concessions to the UK over Northern Ireland in the latest Brexit negotiations. The EU will propose cutting as much as 50% of the customs checks in Northern Ireland and up to 80% of the sanitary checks on food imports. The Northern Ireland Protocol keeps the province in the EU single market, and like the rest of the UK wants changes in that agreement. The International Energy Agency warns that the world isn't investing enough for future energy needs. The agency says that investment in green energy, such as solar and wind, is falling short of what's needed to keep the planet from warming up. At the same time, the IEA says spending on fossil fuels is lower than needed if demand growth for oil, natural gas and coal does continue. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang
kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Might it impact China's growth because it is already slowing? Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie, the older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The fact is that if there are fewer dollars to spend, there are choices to be made. And members have said, let's get the results that we need, but we will not diminish the transformative nature of what it is.
There are choices to be made. Speaker Pelosi there, down in Washington. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market positive, 0.25% on the S&P. We're up 12 points going into numbers from JP Morgan, then onwards to CPI in America, 8:30 Eastern time. Yields in, again, this curve's been flatter over the last day or so. Yields in again by a basis point on 10s. We had 160, now we're back at 156.29 on a 10-year yield, Tom. Crude in as well, just about clinging onto that 80 handle, $80 and about 20 cents. We're negative there, Tom, 0.6%.
Did we get to a 162? I think so. So we're in a 5 solid basis points.
We've come down, and much more so on 30s, Tom. Much more so on 30s. There was some real curve flattening in yesterday's session.
Yeah, I don't make light of it. I think it's very important. We've got a hugely busy schedule this morning, and right now we're going to talk about the mood down here in Washington. And as always, Washington is the sum of its fears. Pelosi's 82 years old, and the Republican from Kentucky, John Yarmuth, he was a Republican, and then he switched to the Democratic Party and became very lonely, and more lonely tomorrow at 73 as he announces his retirement. Anne-Marie Horton here on a Democratic Party that's falling apart. We've seen this script before.
Yes, we have. And for Yarmuth, as you say, he is the lone Democrat in the Kentucky congressional representation. So this is a very, very important seat. But we should say Louisville as well, though. Biden carried that with a pretty high margin. We have to wait to see what the redistricting, but you have to imagine the Republicans are going to get in there. And already the Republicans are saying this just shows a little bit of the old timers on the Democrats that they know they're going to lose the majority. They are going to be out now, and they're going to start to make that known.
And dovetail it with Virginia. Okay, Terry McAuliffe, and there's a tight battle there as well. It's featured in the Post this morning. Dovetail the sweat they have right now over to Speaker Pelosi, speaking about an infrastructure bill and a diminished social program. How do you link the two together?
Well, it's all about whether or not they can carry through to the midterms. What do they do now that they can go home and sell to their constituents? When you're talking about what's going on in Virginia, what's interesting, the Post this morning is the analysis of the voting demographics. One key that helped Biden win the presidency and then helped a number of Democrats is women coming out to vote, because they were just infuriated at times with some of the rhetoric coming from Republicans, especially President Trump. The analysis that's coming out of Virginia is that those women might stay home. They're now disengaged in politics, and that can help the Republicans.
Anne-Marie, why is Tom in Washington?
Well, that's a great question. We love having him here. Very warm welcome to Tom Keene. He's here, of course, for the IMF meetings. He comes every year for these meetings, so he's probably the best placed person to have Bloomberg to be here for it.
The reason why I ask is because there are these IMF meetings, also the World Bank, also G20 meetings that are taking place for the third day today. Does any of this matter, or has the credibility of a lot of these policymakers lost so much clout that people aren't even watching what the proceedings are?
It's definitely a weird meeting, as Tom mentioned earlier, in the sense that there's still a number of social distancing going on in Washington, D.C., mask mandates as well when you go into entrances. But when it comes to the IMF and Kristalina Georgieva, her speech is going to be highly watched. And the question is whether or not she becomes a lame duck for the remainder of her reign at the IMF because of this uproar that she has faced regarding her that report at the World Bank. If that was to happen, as you say, Lisa, the institution like the IMF, people will certainly potentially not pay as much attention to. But I think it's important to note that yesterday with the IMF report, a number of individuals are paying attention to that, especially as they lowered their growth forecast. And they also mentioned supply chain disruptions, which is going to be key for Washington today, because President Biden will be speaking on that.
That's where I wanted to go. And by the way, just for the record, I'm very glad that Tom is down there. Everyone is, and we're looking forward to the updates from there. But I want to ask about that 2:20 p.m. speech from President Biden today, where he plans to address the supply chain disruptions, especially on the heels of the Apple report that we got from Bloomberg's very own yesterday. What do you expect him to say? What can he actually do to materially reduce these frictions that are ongoing?
That's a great question. What power does the administration have over private companies and labor unions? What the White House has been doing is really setting up task force for this, becoming an interlocker between these groups to make sure they can start to ease some of these supply chain disruptions. One thing that we did see happen in California is some ports moving to 24/7, meaning they're working weekends, they're working through the night. That could potentially ease some cargo. We expect them to make an announcement on that. And he's going to be joined virtually by a number of executives and labor union leaders. So potentially he will announce what they are going to do together. So really the White House is there to kind of help provide and the communication of these groups, but they don't have the authority to do anything outright.
But the difference here is Jan Hatzius at Goldman Sachs timeline is longer than any politician in this city. They don't have the luxury of waiting for late 22. Images are going to be formed through next year about the political battle in this nation. What do the moderate Republicans and what do the moderate Democrats do? What's their plan now? I don't see one.
Well, it's a great question because all the companies are saying this is going to last well into the end of 2022. You heard Caterpillar say that. The moderates want hard infrastructure to get through ASAP, and potentially for them,
why is that off the map? I'm fascinated by it. What are the liberal Democrats thinking?
It is off the map because the liberal Democrats want to make sure that they hold it as leverage so they get their social spending plan through. Now, when it comes to